In New York City, I'm Shauna Smith alongside Jared Blickery. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help you, the investor, make smarter decisions for your portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
Happy Thursday, Shauna and viewers. Stock futures higher this morning as investors digest another fresh inflation print and consider what it means for next week's Fed decision. And Treasury yields also ticking higher this morning. Shauna?
Yeah, but take a look at what the 10-year up just around 1 basis point. It's not a huge uptick, still well above that 4% level. Well, we also got a read on the consumer here. Retail sales rebounding in February as higher gas prices moved to the upside here, but the print falling short of expectations. So let's dig into it and get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Alexandra Canal, Josh Schaefer, and Brian Zazi have more.
Hey, Shauna, another hotter than expected inflation print out this morning. Producer prices rising 0.6% on a monthly basis compared to the 0.3% that was expected, and rising 1.6% year over year versus the 1.2% that was expected. We also saw retail sales tick higher in February, up 0.6% in the month, though slightly below expectations. Still overall a reversal from that slump we saw in January.
Former Treasury Secretary Steve Mnuchin saying on CNBC this morning he's putting together an investor group to try to buy TikTok. This comes as the U.S. House of Representatives passed a bill on Wednesday that would force TikTok's Chinese parent company ByteDance to divest the social media app or face a ban in the U.S. Mnuchin said he thinks the legislation should pass and that TikTok should be sold.
And investors are running away from Under Armour shares on surprise news that CEO Stephanie Linnartz is stepping down after just about a year at the helm. The brand's controversial founder, Kevin Plank, is returning to the role after moving aside 4 years ago. Plank returns to see a stock price down 85% from its 2015 highs as the company bleeds market share to Lululemon, Nike, and a host of other apparel upstarts.
Our top story today, futures pairing gains this morning as hotter than expected inflation data continues to dent hopes that the Federal Reserve will cut interest rates in the coming months. Wholesale prices jumping 0.6% on the month. That was higher than the 0.3% forecast. Meanwhile, retail sales rising 0.6% month over month compared to an estimated 0.8% increase. We have got team coverage with Yahoo Finance's Ali Canal and Josh Schaefer. Josh, let's begin with you on retail sales, please.
Yeah, Jared. So taking a look at retail sales, I think the big story here is just that we saw any sort of a rebound. We saw the number get revised down in January to minus 1.1% was that January number. So to see some level of a rebound here, I think is just a positive sign when you think about the consumer still being in good shape, and especially with what Ali is about to talk about on the inflation front. I would say a number that it's good that this number wasn't much higher. I think we'd be starting to get to the point where people are getting concerned about economic data perhaps coming in too well with some of these inflation prints that we're getting.
Yeah, certainly. And Josh, to that point, and Ali, to bring you in here on the conversation, there's a lot of focus on these PPI prints over the last several months because of what it really tells us about the overall inflation picture. And taking a look at this print, the Fed still has, looks like a longer way to go than maybe even the street is realizing at this point.
Yeah, and the producer price index measures the cost of goods for those producers. And similar to the consumer price index that we saw earlier this week, inflation continues to remain elevated. According to the data, producer prices are at 0.6% in February over the prior month. The expectation is that prices would hold steady at 0.3%. So PPI coming in hotter than expected and hotter than January's results, excluding volatile categories like food and energy, because we do know that gas prices were elevated for the month of February. Prices did rise 0.3% month over month, but that was also hotter than expected. It is a deceleration from January's 0.5% monthly gain. And then on a yearly basis, PPI final demand coming in at 1.6%. 0.6% hotter than January's 0.9% rise. So the Fed still has its work cut out for it. But I am looking at what the markets are pricing in right now. They are still very firm on a June rate cut. They're still very firm on 3 cuts coming this year. I think next week, if we're going to be receiving the Fed dot plot, if there's any continued movement there, that could have a serious reaction on the markets. But if that comes in as expected, if there's 3 rate cuts that the Fed thinks are coming, if there's 3 rate cuts the market thinks are coming, that's ultimately going to be a good thing for stocks. And, we are seeing Treasury yields go up a bit higher, but stocks futures still in the green right now.
Yeah, the market hearing what it wants to hear, or taking a look at what it wants to look at here within these reports. Yeah, just another day, and it's the same sort of narrative here.
Yeah.
Yes, stocks usually go up. All right, guys, thanks so much for breaking that down. Let's talk a little more about what this means for the Fed's calculus, because the February PPI print showing that inflation still remains sticky. Top line and producer price rising 0.6% on a monthly basis. That was more than what forecasters have been expecting. We also got a read on the consumer this morning. Retail sales rising in the month of February, rebounding from the decline that we saw in January. Also pointing to the fact that shoppers are still out there spending. So let's talk about what this all means for the path forward for the Fed. For that, we want to bring in Lindsay Pieggs, the chief economist with Stifel. Lindsay, it's great to have you here. So we've been scratching our heads a little bit just in terms of the fact that traders are still pricing in 3 rate cuts between now and the end of the year. Is that your base case, or what do you think the Fed is likely to do on the heels of these latest prints?
I think given the stickier than expected nature of inflation, it's going to be very difficult for the Fed to justify a near-term rate reduction. Our base case is that the Fed holds off to the second half of the year before initiating a change in policy. Now, the market, as you mentioned, has capitulated from at least a March rate hike out to June. But I think even that is overly optimistic, again, given the latest inflation data, suggesting that we may continue to see the Fed on the sideline for much, much longer than expected if we're unable to see evidence that inflation is retreating back to that 2% target.
And Lindsay, as far as the evidence goes about that inflation, those inflation numbers not quite getting to 2%, we've seen headline CPI plateau over the last year. Supercore, we don't hear much about Supercore anymore, but that's services ex housing that has stabilized above 4%. So what is the risk that the Fed has to chase inflation to the upside once again?
Well, the risk is that the Fed didn't raise rates to an actually sufficiently restrictive level, that they stopped short of where we should have seen that backup in policy. And they are allowing inflation to become further entrenched the longer they sit on the sidelines and the longer inflation remains above that target. So the risk is that inflation remains above these levels, above 2%, and the Fed is eventually forced to come back into the marketplace and continue to raise rates. Now, that's going to be a very difficult sell to the market, because the Fed has clearly communicated that they're comfortable with this current terminal level of 5.5% on the upper bound. But should inflation remain stagnant, that means the Fed's on the sideline. Should inflation reverse course meaningfully, that means the Fed may have to come back in with additional rate increases.
And Lindsay, we've discussed this with you in the past, but there's just been more and more chatter about that 2% target, whether or not that makes sense in this post-pandemic economy and what the current landscape is right now. How are you looking at that? And what do you think that will ultimately tell us here in terms of the Fed's policy over the next 12 to 18 months?
Well, if you listen to the Federal Reserve commentary regarding the 2% target, the Fed chairman specifically has been very clear. He said 2% is our target. It's always been our target. It always will be our target. So he clearly is not wavering from that mandate of 2% nominal price growth. Longer run, the Fed may be more willing to have a conversation to provide them additional wiggle room in terms of that inflation target. But right now, they cannot deviate from that 2% target without potentially sending inflation expectations much higher, which would feed back into the real read of inflation and simply compound the difficulty for the Fed to reinstate price stability.
And I want to take a quick detour to the jobs market, because we did get some jobless claims numbers this morning, 209,000. Street was expecting more. And then on continuing claims, that also came in light at 1,811,000. Just wondering what the labor situation is. We have a tight labor market. It's remained that way. How does this fit into your Fed calculations?
Well, the Fed has a very clear dual mandate: stable prices, full employment. When we look at the labor market, it's very clear, whether you look at the pace of job creation, the initial jobless claims, wage growth, all of these components suggest a very tight labor market. So the Fed can comfortably check the box of full employment, suggesting then that their full attention at this point is getting to that second goal of price stability, reinstating stable price pressures in the U.S. economy. So that is entirely their focus. That is their directive at this point. And unfortunately, market conditions have simply posed more and more challenges to achieving that goal.
All right, Lindsay Pieggs, always great to get your perspective here. Thanks so much for hopping on with us this morning. Chief Economist
Thank you for having
with
me.
Stifel. Thanks, Lindsay. Well, former Treasury Secretary Steven Mnuchin announcing on CNBC this morning that he is putting together an investor group to buy TikTok. This coming after the House advanced a controversial bill Wednesday giving China's ByteDance 6 months to divest TikTok or face a ban. Mnuchin saying that he thinks the legislation should pass the Senate and TikTok should be sold. For more on TikTok's fate, we want to bring in Dan Ives, Managing Director and Senior Equity Research Analyst at Wedbush Securities. Dan, it's good to have you here. So the headline this morning that Mnuchin is trying to put together an investor group to buy TikTok. What do you think of that?
I mean, join the club. I mean, many others strategically and financially are going to go after TikTok. The issue is we only think there's a 25% chance that this legislation actually gets done in terms of approved through the Senate. And it's a slippery slope because at the end of the day, no one's going to buy TikTok without the actual code and source and algorithms. And that's the whole issue here. China and ByteDance are not going to do that.
Dan, 25% chance that TikTok ultimately gets banned. That's not nothing. How messy could this process be? Because I remember 4 years ago when we had Trump in office and we were dealing with these headlines here at Yahoo Finance. It was messy back then. What do you see the procedure here and how long could this get dragged out?
This is going to be a Broadway show, essentially in the Beltway. In terms of as this all plays out, our whole issue is it's sort of touching the third rail in terms of where this could all go relative to First Amendment rights, others getting involved, China retaliatory. And that's why the Senate, I mean, we guys see, right now a lot of questions in terms of Schumer. Does he actually bring it onto the floor? We don't think so, at least in the near term. But in terms of Mnuchin and others, I mean, there's going to be a line for those that want to buy TikTok. But the whole issue continues to be the source code that will not come with it. And that's really the golden jewel.
So, Dan, you're saying a lot of people are going to be interested. Who? And who does it make most sense for?
Look, I mean, if Microsoft, Oracle, I mean, any big tech player, Amazon would look, I mean, any big U.S. big tech player, as well as strategic and financial buyers are going to get lined up. But then it comes down to, without the source code, the value is massively different than with. ByteDance China, they're not going to ultimately be a for sale, and they're going to sell this with the source code. This will also have massive regulatory legal issues as it gets held up. And also, if U.S. puts a ban on it and then it gets bought by some of our biggest U.S. technology companies, I mean, that heads down a very slippery slope, especially with retaliatory that we would see coming from Beijing.
Yeah, so Dan, who is at most risk then if we do see retaliatory from Beijing? Is it Tesla? Is it Apple? Who then stands to really be caught in that crossfire?
Well, that's the issue. I mean, right now for Cook and Musk, I mean, they're watching this closely because they know retaliatory, they got the bullseye in the back. And I mean, Jared talked about it, but if this is just theater, just like call it 4 years ago, it's all for naught. It's really a road to nowhere. I mean, it looks great in terms of the microphones down the Beltway, but once you go down, you can't put genie back in the bottle. And we don't think the market's even pricing in positives from Meta here. Because the market's basically pricing, and this is at a standstill.
Dan, I keep coming back to this no source code, and I'm trying to wrap my head around what's going on here. If a sale takes place without the source code, who maintains it? How is it maintained? Because what I understand is that source code is key to getting TikTok around certain app store in terms of Apple's app store and Google's as well. It helps them circumvent a lot of the restrictions that a lot of companies in the U.S. happen to face.
Yeah, look, without the source code, the value's 60, 70% less. So that, and then ByteDance and China are never going to sell this with the source code in a forced sale. But again, that's why Oracle, Project Texas, that's the whole goal in terms of no backdoors to Beijing. CFIUS is obviously still ongoing investigation with no timetable. This is very complex as this all plays out. And obviously a groundswell in terms of the House. But now from a Senate perspective, from all of our advisors and all of our work in the Beltway, I mean, we still believe 25% chance this ultimately gets banned for sale in terms of on Biden's desk. But until that, it's not just minutia. Others are going to line up to potentially buy what's really a unique golden asset.
And they're lining up to buy something they don't even quite understand what the finished product is or what's going to be sold. China came out recently, I believe, and walked back. They said that there is no data that exists in China. So do we even have a handle on where that data exists? Is it in China? If it's not in China, where in the world is it? And is that data part of the sale? I just can't wrap my head around this.
Yeah, that was the whole part of the CFIUS. And even last March, when TikTok was in front of the House, any backdoor. That's why Oracle has been involved as a strategic partner. That's the CFIUS investigation. It's all about that. So the problem here, it's easy to get into the sort of grandstanding, but then you have 150 million users, one of the most popular social media apps out there in election year. You know, so 18 to 24-year-olds, like, are you going to be banning TikTok in the face of that? So there's a lot of third rail issues here, but it goes back to, do you buy an F1 car without the engine?
Heck no.
I would not buy an F1 car without the engine, so I don't even know why it's going up in the auction block, but I appreciate you sharing your best guesses about what we know right now. Dan Ives, Managing Director and Senior Equity Research Analyst at Wedbush. Great to see you. All right, Under Armour stock is under pressure this morning after a leadership shakeup at the company late Wednesday. Under Armour founder Kevin Plank retaking the CEO reins from Stephanie Linnartz, who has been at the role for just over a year. We just had Linnartz on our new leadership series, Lead This Way, and here's what she had to say about being CEO with the founder as executive chairman.
Having the opportunity to work with the founder is pretty special. And I think it's fantastic for me as the CEO. I think it's fantastic for the company and the brand that the founder of Under Armour is our executive chairman and brand chief, and is deeply passionate about the company that he founded and is deeply passionate about supporting me as the CEO and growing the company.
And to break down what this means for investors, we have Yahoo Finance's Brian Sozzi. Brian, timing is interesting here. Any inclination that something might be underfoot, some big leadership changes when you had this interview?
Well, no. So if you want to tie this all in a bow, it's essentially this. Here's the story. Rich, aging quarterback wants to buy back his toy. And that is essentially Kevin Plank, who owns 65% or 65% voting control of the company. And he wants to take this company back, likely before they open up a new headquarters in about a year, just down from where he originally started Under Armour. But nonetheless, people that I've been talking to over the past 12 hours suggest this was a surprise to a lot of analysts on the street. Also a surprise to Stephanie Linnartz, based on what people have been telling me. But also comes at a time where the business was being rebuilt essentially by hand by Stephanie and her entire new leadership team that she's brought on over the past 6 months. So lots of moving parts here. Generally, the vibe on the street is, look, the analysts are giving a lot of praise to Kevin Plank. He did found this company. He was selling T-shirts out of his car in the late 1990s. Is an American success story. But let's keep in mind, it's a company that has had a lot of cultural issues, a lot of major operational missteps when Kevin Plank was in fact CEO. And really, one of the things that came up between me and Linnartz was this thought of culture. Linnartz telling me that she is very much focused on servant leadership and rebuilding the company's culture. Here's what she told me. I'll lead this way.
That old expression that culture eats strategy for lunch, but I think you need to have a strategy for culture. I do think you need to have a strategy for culture, and I think that the CEO plays an important role in driving the culture of the company. And the culture that I want to have at Under Armour and that we have at Under Armour is one of winning, of grit, of determination, of belief.
You do this long enough, guys, and as I have, I still look young, but nonetheless been doing this for a while. And really, some of the biggest success stories or turnaround success stories in corporate America have come because a new CEO has come in and reset the corporate culture right down, and that helps the way of thinking. It helps thinking right down to even the ground level. Now, it takes time to rebuild a culture. It takes time for those efforts to pay off, but usually they do start to pay off 1, 2, 3 years down the line. And it's just something I think Kevin Plank didn't want to give Lennartz time to do. Interesting point on culture here. I'll just continue this thread. Timeline of some of the, I would say, some of the biggest flops under Kevin Plank as CEO, and there have been many. A couple things there worth calling out. Bought a digital series of digital assets in MyFitnessPal nearly at the top of the market, sold it for far less. Came out at the start of the Trump presidency with supportive comments for President Trump that really ruffled the feathers of Steph Curry, of course, a key asset, endorsed athlete for Under Armour with that Steph Curry line. Ironically, one of the first meetings that Lennartz had, she told me, was with Steph Curry just to rebuild that relationship in large part because of those bungled comments in a TV interview by Plank, always known to put his foot in his mouth. Then you had the Wall Street Journal reporting in 2018 that strip club visits were reportedly allowed to be expensed at Under Armour. Under Armour looks like they course corrected on that. And then one of the more bizarre stories, in 2023, there were reports coming from a new lawsuit against the company that Plank shared confidential information with TV anchor Stephanie Ruhle. So there's been a lot of going on, and against backdrop of really this, you look at the last 10 years of results for Under Armour with Plank largely at the helm. Sales have aggressively slowed down, margins have degraded, the company has lost significant market share to Lululemon, Nike, a lot of upstarts in the space. So this is not going to be easy shit. Now, Kevin Plank posted on LinkedIn. I should mention Under Armour now want to make Plank available for an interview to me. Also really not being made available to any folks on Wall Street, so tight-lipped for him. Did post on LinkedIn, though, that he seems to be a changed human being, and because of that, he might be a changed CEO, to be told. But he has a lot to prove, and really, he can't come back in here in Under Armour thinking he's going to run this ship like he did, the prior 10 years. That's not going to cut in this environment.
Sounds real cool. What do you make of the stock reaction to this?
It's the correct one.
It's the correct one?
It's the correct one. Not only do you have the surprise factor of pushing out a respected leader in Stephanie Lennartz, who had a lot of tremendous success at Marriott. Some of her efforts, her management team, the management team she hires, that they hired, they were all new, incredibly respected. John Varvatos, the fashion designer, is the chief designer of this company. So she has started to reset the culture, and there were signs these things were starting to pay off and may have started to pay off later this year for the holiday shopping season. And again, I think there's just this lack of trust in Plank. This is a company that grew the company too aggressively, led to a lot of bloat. You have the controversial headlines, and the strategic direction of what Plank wants to do is wildly unclear. So I wish him good luck, but he has a lot to prove, and all I can say is I hope he runs the company better than he did in the prior 10 years, because if he doesn't, this could very easily be a $2 stock 5 years from now.
Yeah, well, in the pre-market, it's below $8 a share, off another 7%. All right,
Yep.
Sas,
Appreciate it.
Keep right here on Yahoo Finance. Much more ahead. Robinhood shares are surging in the pre-market after Bernstein initiating coverage with a buy rating. We also got new numbers out from Robinhood in terms of what they're seeing interest on their site for the month of February. We've got that for you when we come back.
Let's take a look at some trending tickers. President Biden speaking out against the sale of U.S. steel to Japan's Nippon Steel, saying the U.S. needs to, quote, maintain strong American steel companies. That's according to a statement obtained by the AP. And Shauna, just looking at the chart here on the Wi-Fi Interactive, it's year to date. It's down 16%. Most of this coming just very recently. And I think it's instructive. Here's a one-year chart. Never quite got above, what is that, $50, and the purchase price is $55. So I think this just indicates there was always a bit of skepticism over what this deal would bring.
And with the Nippon, it's not exactly a massive surprise here. We're extending the losses that we saw yesterday when the stock closed off nearly 13%. But Jared, you're exactly right to highlight what you have circled there on the screen, with shares closing just above $40 a barrel, which is about 30% below what the value was or at the offer price here for this deal. So there's no outright pledge here to block it from President Biden, but from the reports of the statement that we are going to get later today from President Biden, he is likely to address and bring up some of those serious concerns that he has of U.S. steel not remaining domestically controlled. We also have to bring up the political side of it, right? Because it is an election year. We know there has been some pushback, some concern amongst the U.S. steel workers here. So the fact that it has such a large base within Pennsylvania is a swing state. You got to think, obviously, that the 2024 election is playing into this somehow.
You think? I mean, just remember what Donald Trump did with the U.S. steel headlines 4 years ago. It was quite in play. Also, real quickly, CFIUS, that is a Committee on Foreign Investment in the United States. It is shrouded in secrecy. We don't really know what goes on there, but that's another wild card that we got to at least account for in our considerations.
All right, so keep your eye on U.S. steel today. We also are taking a look at shares of Robinhood, another trending ticker here on Yahoo Finance. You're looking at a move to the upside, up just about 12%. Bernstein initiating coverage on the stock with a buy rating, a $30 price target, about $11 higher than where it closed yesterday, saying that it continues to benefit from the crypto comeback. Our executive editor, Brian Sazi, spoke with Robinhood CEO Vlad Tenev about the crypto rally last week. Here's what he had to say.
When the crypto markets see a lot of excitement, we benefit from that. You know, we're one of the largest crypto platforms in the U.S. We've been growing market share, and that's continued through 2023.
All right, so he's saying that they're seeing a lot of activity on the platform. We're also getting February data numbers out from Robinhood. That was released late in the day yesterday. And taking a look at those numbers, they did see another, it's very impressive, another month-over-month increase here. More people are spending more time on Robinhood. They're seeing an uptick in activity as you've got the stock market at record highs, crypto at record highs. They're one of the big names that are benefiting.
Crypto coming back is such a tailwind, because I've had people calling me, should I cash in my crypto, which is just now coming back to their original purchase price a few years ago. This is money in the bank that was somewhat unexpected, and I think it has a wealth effect for a lot of retail investors. But here's some of those numbers we were talking about for those February results. Assets under custody now closing on $119 billion. That's up 59%. Equities trading volume, that's stocks, not crypto, up 41%. Options trading up 33%. So some pretty impressive numbers there. And I think just overall, stock market at record high, plus crypto at a record high for a lot of these, not including, not the least of which is Bitcoin, is just a huge tailwind for stocks, I should say.
Yeah, we certainly have seen that, and you're looking at Bitcoin still remaining above $72,000 here. But getting into this call from Bernstein, who initiated coverage on the stock this morning with an outperform, with a buy rating here, a lot of that tied to the strength that we're seeing within crypto. They're making the case that the crypto revenue, they see crypto revenue for Robinhood growing ninefold in 2025, and they actually think Robinhood might have an advantage over other exchanges like Coinbase here because of their competitive fees. So they're thinking that Robinhood's going to be one of the big beneficiaries here of the crypto rally going forward. But again, Jared, you were just going through some of those impressive stats that we're getting out here from Robinhood. Assets under custody growing 16% on a month-over-month basis. It was also the second month in a row that we saw Robinhood's assets over $100 billion. So the uptick that we're seeing in the activity clearly reflected in these numbers in Robinhood's business. And again, a huge winner, at least in the early action here today, as we ring the opening bell on Wall Street, kicking off another trading day. Excitement playing out on the floor of the New York Stock Exchange and the Nasdaq, and taking a look at where things are opening this morning. It looks like we are going to be holding on to some of those gains that we saw in the pre-market. Readings out from retail sales, also the latest inflation print on the wholesale side with PPI coming in a bit hotter than forecast, but not doing enough to dampen some of the excitement that we are seeing on the street here. So again, movement to the upside. We'll see if it's another day.
Oh, come on. We're gonna intro our next guest in a second, but hint, it is a bull boss. And let's take a look at the Wi-Fi Interactive here. We got the Dow. This is a 2-day look. So we dipped into negative territory late yesterday, have since recovered up about 0.25% today. Nasdaq, that is in the green for 16 basis points, but still underwater over the last 2 days. And here's the S&P 500 up just a smidge in today's in today's trading action. Also want to get a check on the VIX here. That has been muted. It's still down to about 13, has a 13 handle, 13.5% or 13.5. That is a level. And then here's the 10-year T-note yield. That is up about 4 basis points. Let's show a 3-month chart here. Here's that high, that recent high that we had in February. We came down, but we are now in the middle of this trading range. So not a lot of pressure there, but want to keep an eye on the upper and lower bounds of this recent range here.
All right, well, let's get right to it. What you could expect for this trading day. U.S. stocks moving higher this morning, despite the latest read on inflation. Wholesale prices coming in just a bit hotter than expected for the month of February. We're also seeing some resilience once again in the consumer. Retail sales are rebounding last month, slightly moving to the upside here, although slightly below what the street had been expecting. So here to break it all down, what this means for some of the momentum in the market. We have Ryan Dietrich joining us on set, Carson Group's Chief Market Strategist. Ryan, it's great to have you here. So help us make sense of the moves that we're seeing in the market here. We're up against those record highs. Enough to keep the momentum?
Yeah, first off, March 14th, Happy Pie Day. You guys talked about that yet?
We haven't, no.
Okay.
30 minutes
so
in.
There we go.
Thank God you're here.
Happy Pie Day. So listen, I mean, we've been optimistic. We've been pretty bullish. Let's just put it in context. And now, Jerry, you talk about these things. Up 16 and 19 weeks on the S&P, maybe 17 out of 20, 24% gain those 19 weeks. That's like never happened before. So this has been a great run, historic run for a lot of reasons. We can get into some of the things. What caught me this morning, though, that we're still bullish, maybe a little pause would be normal. Yes, inflation's a little hotter. Maybe you could argue the retail numbers a tad weak, but look at claims, 209,000. I mean, just quietly, you hear about these big layoffs, yet there's no initial spike in initial claims. I mean, the consumer is still strong. Wages are still strong. Inflation, we can get into that stuff. But overall, this backdrop is still there. It's a strong economy, and it's still a bull market.
And the continuing claims also down. So, I mean, we're focused on the inflation data, trying to figure out what the Fed's next move is, but the market is always trying to get ahead of the Fed. And for all the bearish calls that we've seen, for all the calls that the market is extended, as you said, we pretty much haven't seen this before, at least not recently. What could put a pinprick in this rally and pop this little bit of a, I don't want to call it a bubble, I'm trying to shy away from that word, but how do we do some mean reversion and get into that?
Real quickly on a bubble, I mean, the last 6 weeks, S&P 500 forward estimates for 12 months are up 2%. That's a really big move. I mean, this has been a big move, but earnings have justified it. So we would say we don't think this is a bubble. But I think it is that F word, right? The Fed. I mean, the Fed next week. We saw on January 31st, that was the last Fed meeting. That's when they really pushed back on 6 or 7 cuts, maybe 3 or 4. Now we're down to 3 or 4. What's amazing since January 31st, what's led us? The cyclical areas. Materials actually has led. Materials has led. Industrials, financials. I mean, that's kind of, I don't know if it's surprising, but it's the message of the market that, listen, we're rallying because the economy's strong. And, we've all done this for a while. Do you really want the Fed to always kind of be in charge? I'd say no. I mean, we know rate cuts are coming. Maybe it's going to be 3 or 4. That's fine. When's the first cut? I think Fed Fund futures, last I looked, was about a 15% chance of a cut in May. We would say it's more like 30 or 40. We're not saying it's going to happen. But, we do have another CPI come in. We do have another 2 PCEs. I mean, as we looked a couple days ago on, core CPI, if you take out ex-shelter, we're running like 2% the last 6 months and last year. We all know shelter kind of is fluky with the numbers, so we're still optimistic that, hey, there's still some cuts coming, but it's all about the economy.
So, Ryan, if they do cut in May, if they end up, your expectations obviously a little bit more optimistic than what we're seeing priced in more broadly for the market. Going off of what you're just saying about broader breadth that we've seen within the market, is that a trend that you see expanding here in the coming months?
Well, we do. I mean, that was one of our big themes this year. Of course, we all know tech and communications did great, this broadening out. I mean, the group that no one's talking about, if you look at the models we run for our Carson partners, we're the most overweight mid caps. Everybody's small caps or large caps. Mid caps are quietly leading that kind of passing of the baton. If you would have told me, 6 weeks ago, Apple would be down, Tesla would be down as much as it is, and oh, by the way, rate cut expectations would be pushed back. I mean, I would have said, oh, we might be down, but we're not, right? And again, that's the key thing. So this rotation is so good, nice. The last point on this, Russell 2000 been tracking in that range. It's starting to pop above. I know it's not all-time highs, but almost. It's inching closer. We like small and mid to continue to kind of lead really the rest of this year, and we think it's still a bull market.
All right, Ryan Dietrich, always great to have you, especially when you're on set here with us. Thanks so much for hopping on with us this morning. Carson Group's Chief Market Strategist. Thanks, Ryan.
2, 3, 1.
Well, moments ago, SpaceX launching its third test launch of its Starship rocket from its Starbase facility near Boca Chica in Texas. Now, the company's 2 previous launches were unsuccessful, the last of which ended in an explosion over the Gulf of Mexico in November. Now, Starship is the world's largest rocket designed to eventually transport people to Mars and the moon. Lots of excitement. You always get excited, Jared, when you're taking a look at a rocket launch here, but especially, but just what this means here for SpaceX and the global race to get to space, and also just the competitive edge, obviously, that they have right now between them and some of the rivals within the space industry.
Yeah, and isn't it? It's an exciting race. It's the next It's a next step for humanity. First, going back to the moon, we hadn't gone to the moon since before I was born. I know before you were born. It's not even in people's memory. That's how long it's been. And here we are gearing up for that final flight. Of course, there are some failures that we've had recently in memory, but we'll have to see. Everything looks like a go right here. And Shauna, I've looked at a few of these over the years, and I've been to Cape Canaveral for a launch, and I can tell you that if you're on the ground, it is the most incredible moving feeling that I've ever had. Only thing that may have trumped it was a Taylor Swift concert, which was in sheer volume of the audience screaming, but I do compare that to a space launch here.
I can't believe Taylor Swift edges
I had to get that in.
Wow. The fact that you're still a Swiftie.
Well,
I'm surprised by that.
All right, my girlfriend is, okay? So
well,
I go to
sounds like you're a pretty big
concert.
Swiftie fan if it's going to outweigh a rocket launch. But guys, just to put it in perspective, how large that rocket is that we were just showing you on the screen, 30 feet wide, standing nearly 400 feet tall, about 90 feet taller than the Statue of Liberty, and also weighs more than 11 million pounds when fueled. So we, of course, are going to keep a close eye on that. But SpaceX launching its third test of the Starship rocket. Keep right here on Yahoo Finance. Much more of your market action ahead. Again, we are looking at gains across the board. All 3 of the major averages moving to the upside. We'll be right back. Time for some trending tickers. Dollar General shares moving to the upside, up just about 1.5% in early trading. Same-store sales coming in better than expected, climbing 0.7% from a year ago. Now, the discount retailer also giving first quarter same-store sales estimates above expectations. So a bit of a different story playing out at Dollar General than what we saw at Dollar Tree yesterday, especially when you take a look at the stock reaction here today. But again, some strength that Dollar General is showing in their same-store sales, and that's offsetting some of the weakness that the company saw in its apparel and its seasonal goods and also in its home products divisions there. So not strength across the board, but enough to beat the street's expectations here, Jerry.
Yeah, and those expectations, it was a low bar. Let me just say that. If we go to the Wi-Fi Interactive, I'm going to chart the price action first. This is over the last 5 years, so this covers the pandemic. You can see a pretty steady rise here, but then peaking out at the end of 2022. By the way, 2022, which was when the general market was in a bear market, Dollar General staple company outperformed, but then just fell off a cliff. Here's the 2-year chart, and you can really see some of the losses there, down about 23%. Although year to date now with the 1% or 0.75% gain here, it's up 17%. I do have some street reaction. Here's Truist, which rates it a hold with a price target of 125. While we think Dollar General is making needed improvements to its business, the stock is already trading well above its historical relative valuation despite relatively little or no growth. And so it's trading above that level, which means that traders are too optimistic, at least in terms of this one analyst. All right, we got to take a look at another trending ticker, and this is Dick's Sporting Goods. It's surging. Looks like it's up 17% now after posting an earnings beat in the fourth quarter, seeing same-store sales climb 2.8% from a year ago. Shares of Dick's Sporting Goods up nearly 30%. What? How much is that this year? 49%, so almost 50% year to date as I have this up on the Wi-Fi Interactive. And just as Dollar General was suffering over the last 2 years, basically, flip side for Dick's, you can see over the last 5 years, it is up 534%, Shauna.
Yeah, net sales of $3.88 billion, topping the street's expectations here. Comp store sales rising nearly 3%. They're up 2.8% in the most recent quarter. They were, though, lower than that more than 5% jump that the company had reported just about a year ago. But they're also boosting their dividend, another theme that we've seen play out this earnings season here from several of those in corporate America here. So Dick's Sporting Goods raising their dividend here, their special quarterly dividend, 10% to $1.10 a share. But again, the stock gaining here in the pre-market, a massive move to the upside, Jared, up just about 17%.
Yep, you bet. All your markets, all your markets action is straight ahead. Stay tuned. You're watching Yahoo Finance.
All right, let's take a look at Nvidia. The stock is back in the red today, down more than 5% over the past week. The move lower coming ahead of its upcoming annual developer conference. That is all the hype, and that is a big focus. One of the big focuses here on the street over the coming week. Now, investors are looking ahead for news that's going to fuel the company's growth after a roughly 80% surge that we've seen since just the start of this year. And of course, coming off a staggering move to the upside in 2023. We want to bring in Ivan Feinseth. He is Tigris Financial Partners Chief Investment Officer. Ivan, it's great to have you here. So we have Nvidia. It almost seems like nothing, to some extent. Yes, we're seeing some pressure on the stock here today and over the last couple of trading days, but nothing seems to be stopping Nvidia's momentum here to the upside. Is this developer conference that we have on tap next week, is that just going to be another catalyst for the stock?
Oh, absolutely. And in fact, I think the only person right now who could pack more people into an event other than Jensen Huang is Taylor Swift. I mean, the anticipation of this event is huge. It's the first time it's going to be live in 5 years. They're attracting, I think, over 18,000 people. And the big focus is hopefully going to be the announcement of the new Blackwell 100 processor, which will even be more powerful than the upcoming H200 processor.
Yeah, let's talk about that and some of the details there. I'm reading that the RTX 5090 could be 50 to 70% more powerful than the 4090. And this is all to say the cutting edge technology that Nvidia has advanced just gets more cutting edge. How far are they separating themselves from the pack here?
Oh, just when everybody thinks that the competition will catch up, they just blast forward and ahead. I mean, it's not only about the power, it's the speed, the reliability, but most importantly, it's the integration of the software as well as the hardware. They lead on everything. And also, it will be a combination. I mean, for your most critical apps and in critical data centers, you're going to want NVIDIA GPUs. Maybe for secondary services, you'll go to a less powerful processor, but NVIDIA leads the way. And this AI investing theme is just at its infancy, and NVIDIA is viewed as a core holdings in this investing theme. So this is part of what's been fueling the stock's incredible gains.
I mean, are you confident in NVIDIA being able to turn its current massive lead that it clearly has within the AI space into that longer-term dominance?
Absolutely. They are the dominant force, and they will continue to be so.
Let me ask you this. Jensen, he formulated this company well over 2 decades ago, and it seems as though he's been preparing for this rise in artificial intelligence that we've only become acquainted with over the last few years, but this is really decades in the making. How far has he seen, and then how much more does NVIDIA potentially have in its bag of tricks because of this foresight that we haven't even grasped yet?
Because even to quote, I believe it's Tom Siebel from C3 AI who said it, that every company will be a AI company. Every company is going to use AI in some form to better connect and with their customers, to better manage supply chains, to better target marketing efforts. So every AI will be in every aspect of a business and will continue to increase. I mean, Jensen is already talking about, he's been talking about for a long time in healthcare, the opportunities to apply AI in healthcare for drug testing and development, for genomic mapping. I mean, there's so many frontiers that have even yet to be addressed that he has built out the capabilities to enable this. So this has a huge runway.
All right, we're going to have to leave it there. Thank you, Ivan Feinseth, Tigris Financial Partners Chief Investment Officer. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Reliance is cashing in on one of the world's fastest growing entertainment markets. Pushing it even further here, India's biggest conglomerate has agreed to buy 13% of Paramount Global's stake in its India TV business and streaming company, Viacom18. Now, this comes just 2 weeks after Disney and Reliance announced an $8.5 billion joint venture that combines their Indian streaming businesses here. For more on this story and what it means for the play going forward, Alexandra Canal. Allie.
Hi, Shauna. Yeah, so we know Paramount has been a top name when it comes to M&A, especially as the company works to delever its balance sheet. And this Viacom18 deal is really an example of those efforts. As you mentioned, Reliance is going to acquire Paramount's entire 13% stake for approximately $517 million. And that's a heck of a lot of money for a company that's really struggling with its balance sheet and wants to improve its financials. Paramount is going to continue to license content to Viacom18 after completion of the transaction. We know licensing has become a really popular option for a lot of these streaming and media companies, especially when we think about profitability and the future of, the viability of these businesses. But India is a very tough market to really excel in. We've seen Disney retreat from the country, now Paramount. And Paramount has said it will be leaning on lower investment models in markets where it's not yet launched Paramount Plus in order to really grow local scale and make the most of its TV and movie business. So I think a positive for Paramount when it comes to the financial returns, but the company still has a lot of work cut out for it. M&A mill, the rumor mill, it's not slowing down anytime soon. Even our parent company, Apollo, has now been thrown into the mix there. And Bob Bakish, the CEO of Paramount, has said that the company is open to deals and ultimately they want to create shareholder value. So we'll see where this goes, but we're starting to see little signs of them offloading.
We are, because it's about 2 years ago when the analysts started predicting that we were going to see even more M&A activity within the streaming space. And we started to see some signs of it last year, but the rumor mill, certainly, like you're saying, Allie, picking up a lot this year. And you would think they would need to make those type of acquisitions even to be able to compete with the larger players.
I think it's inevitable that we're going to see something happen with this company. I think it all comes down to timing. It really hasn't been an attractive M&A environment with interest rates so high, but everyone has said 2024 could be the year, so we'll see.
We will see.
Still
We're
a lot
only
of time left.
2.5 months in. All right, Allie, thank you so much.
Thank
Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Welcome back to Yahoo Finance. I'm Shauna Smith alongside Jared Blickery. We're about 30 minutes into the trading day. Let's take a look at some of the gains that we are seeing. Stocks moving to the upside, despite the fact that we got another print on inflation, the wholesale inflation print coming in just a bit hotter than expected. And you're now actually looking at the stock market under pressure with the S&P reversing earlier gains off just about 0.5%. So maybe it should just need a little bit of time to digest that econ data that was out this morning, Jared.
Maybe just a little bit of time, and also taking a look at some individual trending takers here. Shares of Alibaba, they are moving to the downside after the European Commission opened a formal investigation into the company's e-commerce site, AliExpress. The Commission opened the probe into AliExpress under its new Digital Services Act, which came into effect only this month to investigate anti-competitive behavior and misinformation.
Another stock that we're watching this morning is Tesla. UBS cutting its price target on the stock from $225 to $165, maintaining its neutral rating. Now, it's not just because of slowing EV demand here in the U.S. Now, UBS seeing possible production challenges ahead for the Model 2 and also stiffer competition among its competitors in China.
And SentinelOne shares, they are plunging after reporting softer guidance than analysts expected. The CEO saying weak margin guidance reflects cost pressures from recent acquisitions that the cybersecurity company did. However, report a fourth quarter loss, adjusted loss they did, that was narrower than expected on revenue that jumped 38% compared to the year prior. And shares of Under Armour they are off a little bit, about 12% today after the company announced a leadership shakeup. And we want to go to the Wi-Fi Interactive, where I'm going to chart real quickly some of the leadership changes they've had over the last 4 years. 4 CEOs. I'm just going to show you a smattering of some of these events. Here in late 2019, before the pandemic, Kevin Plank steps down from the CEO role, had a couple of interims, and then I believe Frisk, he was to step down as of June 1st. That was announced in May of 2022. Then we had Linnartz. Stephanie Linnartz is announced as president and CEO as of February 2023. And you can see by that time the share prices were mired in the lower end of this 5-year trading range, where they are just about there right now. And Under Armour President Kevin Plank retaking the CEO ranks from Stephanie Linnartz, who has been in the role for just over a year. And we've taken a look at some of the stock movements now. So for more on this, we turn to David Schwartz. He is a Morningstar equity analyst, and he is joining us to discuss. First, what is your first blush impression of this latest move? It seems a little bit rushed. Linnartz didn't get much of a chance at the helm, had a 3-year timeline, and she gets one.
Yeah, it's very rushed. There's no doubt about that. Giving the new CEO just a year to actually implement major changes is not enough. Really, that's not a realistic timeline for her to have made a lot of the moves that Under Armour has needed to make to actually fix the business. So from that perspective, I think it's a bit surprising that she was pushed out right now. However, on the other hand, it's really not that surprising that Kevin Plank is back as CEO, because he had never really gone anywhere. As the executive chairman and chief of brand, he had always been very heavily involved in Under Armour, even when he was not the CEO.
David, the extent of the stock's drop here on the news, off just about 12% right now. Does that make sense to you?
Yeah, I think it does, because I think people see this as a sign that the current quarter is not going very well. I think that's part of it. I mean, the company just had a conference call a few weeks ago, and clearly at the time there was no thought of a CEO change. So it does appear that something has happened recently that makes people think that maybe the quarter right now is not very good. I think probably the bigger issue is just that Linnartz's plan really didn't call for big changes in products at Under Armour until probably the middle of 2025. And I think that was just too long for Kevin Plank to wait. I think he wanted more immediate sales growth, and that wasn't likely to happen under Stephanie Linnartz.
But is it going to happen under Plank, do you think?
Well, one thing that he could do is increase the wholesale distribution of Under Armour. Over the last few years, Under Armour has exited about 2,500 stores, which has costed sales. This was an effort to undo problems that realistically Kevin Plank himself caused back when he was the CEO, which is part of the reason why he left the position, because Under Armour's product was over-distributed. So one thing that Under Armour could do is increase its wholesale distribution, but that runs the risk of causing the same problems that it had years ago. If you go back to about 2016, 2017, Under Armour even got in trouble with the SEC for essentially stuffing the channel and making sales to stores that were not real sales to try to make quarters. And so you wonder now, will Under Armour do something like that again? Will they try again to really force retailers to take on a lot of product, which could be potentially a big problem in the long term if it leads to over distribution and price cutting again?
Well, yeah, inventory stuffing, something we see in the automotive field quite a bit over the years. But just thinking about the broader challenges that Plank faces now, coming back to Under Armour, how does he, this is something you're writing about in your most recent research report, that how do they broaden, how does he broaden Under Armour's appeal, especially internationally in certain locations where they've really flagged?
Yeah, Under Armour still does about 2/3 of its sales in North America, which is quite a bit higher than competing companies like Nike and Adidas and Puma. Under Armour just does not have the geographic diversity, and it's missing out on growth in markets like China, where it's still relatively small, and which is really supposed to be a high growth area for sportswear. And so Under Armour does need to expand outside of North America. I don't know, though, that Kevin Plank really intends to do that. I think he's probably more concerned right now about trying to get the sales up in North America. Besides geographically, Under Armour also needs to expand in other categories. The women's sales at Under Armour lag men's by quite a lot. And as we've seen with the success of brands like Lululemon, it's definitely necessary to have a very strong women's business to be competitive in activewear anymore. It's a bit disappointing that Under Armour just released one of the few female CEOs in the industry. You wonder then, will they have the same commitment to the women's business that we've heard from the company in the past? So Under Armour really does need to expand from sort of its traditional roots in football into other sports, other categories, and other geographies.
David, you just listed a long line of improvements that maybe it would make sense for Under Armour to make here in the coming years. What would the number one top priority be? Or should it be?
Well, I think the number one top priority has to be to try to build the brand into something a little bit stronger than it is today. That could be done through differentiation of product by channel. Right now, Under Armour does not do a very good job at all of differentiating its products, so that the stuff that Under Armour sells at Kohl's is not that much different than what it sells at a store like at Dick's Sporting Goods. And Under Armour needs to have stronger products, especially in footwear. Under Armour's footwear business lags the other major competitors by quite a lot. It's only about 25% of Under Armour sales. And it just simply does not have the distribution in stores like Foot Locker and specialty running stores that really a premier sportswear brand needs to have. So I think it really needs to build that footwear business a little bit better.
Just thinking broadly here about the role of these founder CEOs, as you said, Plank really never left. He retains 65% of the company's voting shares. We've seen other CEOs fall into the role of executive chairman over the years. Disney, Schwartz at Starbucks come to mind. We've seen this happen before. Is it a case that the founder just can't let go, but really should? How do you solve this seemingly intractable problem?
I definitely think that he never really wanted to leave. He was basically forced to resign as CEO because there were a number of kind of embarrassing press scandals involving his personal life. Then there was the issue with the SEC and the overdistribution and the declining results. And so I think he was kind of forced to step back, but he never really wanted to. And so I'm not really surprised that he came back. As far as fixing the problem at this point, there isn't any real easy way to do that. Because he still has super voting stock. So it doesn't seem to be much potential for an activist campaign, for example, or something like that. If things don't improve over the next couple of years with him as a CEO, then I think he's going to be under a lot of pressure to go outside and bring in an outside CEO again, even though it didn't work out so great the first time.
All right, well, we might be asking you to come on our program and talk about the fifth CEO in 4 years' time, or I might have lost count there, but we really do appreciate your time here. Morningstar's David Schwartz, thank you. And Disney's search for a successor to CEO Bob Iger, it's heating up. Iger's contract extends through the end of 2026, and there are a number of candidates being considered. Yahoo Finance's Alexandra Canal has more. Allie.
Hi, Jared. Yeah, so there are 4 names that are now being floated around, and these are names that we've heard about before because these are the leaders of the company. We have TV chief Dana Walden, ESPN's Jimmy Pitaro, Josh D'Amaro, who leads the parks business, and Alan Bergman. He also serves as co-chair along with Walden when it comes to the TV and entertainment division of the company. Now, according to a new Bloomberg report, CEO Bob Iger has been spending a lot of time with these 4 potential internal candidates, really showing them his process, exposing them to different areas of the business that they might not have experience with. And Disney may consider appointing a number 2 executive under Iger, so some sort of president or COO position to really learn and step into the role before he officially steps down. As you mentioned, his contract goes through the end of 2026. It's 2024 right now. We're likely not going to receive any type of decision this year, but certainly by 2025, there should be a better sense of who could be Bob Iger's replacement. Now, these are all internal candidates. I wouldn't be surprised if we potentially saw an outside candidate come into the mix here. And obviously, this is in the midst of shareholder pressure, proxy battles. The next CEO of Disney is a really big point of contention that a lot of folks are curious about or interested in. Disney, for its own part, has established a committee led by members of the board in order to try and find the next CEO of Disney. This is a very complicated company, a lot of different areas of the business. We'll see who potentially could come out on top here.
Parks has been a perennial source of strength, but streaming has been the big money loser, but also seemingly on the horizon. It always has this potential, and it's been this albatross for so many companies. What do they do with streaming from here?
I think streaming, they're going to continue to be committed to streaming moving forward. Yes, they need to improve profitability. Bob Iger and Disney has said 2024 will be the year of peak losses. They've reiterated that guidance. So I don't think streaming is going away, especially as we see linear television declines. But that's a major challenge that all the companies are dealing with right now. I think streaming in the context of sports is going to be especially important for Disney. We know they are launching that joint venture with Warner Brothers Discovery and Fox later this fall. And then next fall, 2025, we're going to see ESPN's fully over-the-top streaming service come to market. And Bob Iger has said eventually he sees ESPN just being 100% a streaming service and no longer on those linear channels. So streaming is certainly the future of Disney. I think it's the future for a lot of media companies.
Just haven't figured it out.
It's just a question of who survives. And Disney is one company that's big enough that I think it can survive. But that's up to what the consumers really want and what they choose to watch and pay for.
All right, thank you for that, Allie Canal.
Yeah, thanks, guys.
Fisker shares, they are plunging today. The electric vehicle startup is hiring restructuring advisors. They're preparing for a possible bankruptcy filing, and that's according to a Wall Street Journal report. Just last month, the car maker warned about its ability to stay in business. And I'm looking at a chart here on the Wi-Fi Interactive all the way back to its SPAC IPO before, I think, 2019, late 2018. Let me just show you the 3-year here. You can see down 99%. This is a penny stock trading at 16 cents. And then a couple of quick notes here. This is a company that's very early in the stage of its development here. Their production target last year was 13,000 units. They manufactured a little over 10,000. They delivered 4,900. So this is a company that still has to figure out its business model, already considering bankruptcy, the second for the Fisker name in about 10 years. So you got to wonder what the future is for this name in this very competitive field.
Future does not look bright. At least right now, when you got a stock trading at 16 cents a share, you're looking at a loss of about 50%. That's a record-setting drop here for Fisker stock. It's not necessarily a huge surprise. Like Jared, you were saying, they warned just a couple of weeks ago just about the fact that the company was running out of cash. They also said that they could be in talks or were in talks about some sort of joint venture playbook here for the development of one or more EV platforms. So that, of course, could be a move here, at least in the short term for Fisker. But when you take a look at the financials and what the company has reported in the most recent quarters, late last month, they reported fourth quarter sales of $200 million, which was well below what the street was looking for. They lost $463.6 million in the quarter compared to a narrower loss in the narrower loss than they were expecting here. So I mean, it's just.
It was an EV company that came to market via SPAC over the pandemic. I mean, that was a lot of strikes to get them right there. They still have 5,000 vehicles. I've just one stat here. 5,000 vehicles to sell. They're trying to find a market for them worth $500 million. But at this stage, what do you do? Do you get any service on these vehicles if the company's in bankruptcy? I don't know. That would be a sticking point for me.
It certainly would be. One thing that it would bode well for demand for their cars here going forward. But again, Fisker, a name to keep on your radar here with shares under a tremendous amount of pressure, off about 50% here in today's trading. Here, right here on Yahoo Finance, much more of your market action ahead. We'll be right back. Reddit reportedly telling potential investors on its IPO roadshow that they expect revenue in 2024 to grow by more than 20% from a year ago. That's according to a report from Bloomberg. Now, this coming as a social media company gears up for its public debut. We want to bring in Cameron Ansari. He is venture partner at Headline, joining us now with a little bit more on what to expect. So, Cameron, we got that headline out yesterday from Bloomberg, 20% revenue growth here they're expecting for the current year. What's that going to do, do you think, for investor appetite?
You know, I think not a lot at this point. I mean, I think the story's been told. Most folks that are going to buy the Reddit stock are familiar with what it is. Reddit's a 20-year-old company. It's not a business that started yesterday. It's been a long and winding road to get here. And I think they've priced it attractively, right? The last round was at 10, 11 billion. They've priced it out about 6.5. to try to, I think, create appetite for the IPO so that you leave room for some upside and hopefully a pop on the day of the IPO for those investors.
And Cameron, you've noted there are some risks here, and also considering that first day IPO pop, they're selling a lot of shares to Reddit users, protecting the insiders. But what happens if they don't get that pop? There's just a lot of risk, and I think your list here is interesting. Maybe you could go down some of these.
Sure. I mean, look, one of the biggest risks is this very unusual move they're doing, where they're offering 8% of the float on the IPO day to the users. They're called Redditors, Redditers, or the folks that are that write the content. If you go to Reddit, I mean, I just went to the front page recently. It's really like a chat room, right? It's kind of a throwback site. It's not a very attractive site in terms of the graphics and user interface. It's really about discussion. It's kind of a throwback to the old like Tumblr and like the AOL chat room. So it's got this kind of Web 1.0 vibe. And the Redditors are the people that actually write the content, and they're subreddits. And the 8% they're offering to those folks is not locked up, meaning those people can buy and sell that stock freely the day of the IPO, the next day, which is unusual, where most people are locked up and they can't create volatility. So you may see a big run up in the stock price and a drop, similar to what we saw with Robinhood. And because this has such a rabid community around it, the Reddit users, you could see Reddit itself, ironically, become a meme stock the way that you saw happen with like AMC and GameStop.
The ultimate irony.
Yeah, it would be the ultimate irony.
Do you think it's a smart move here by Reddit to do this?
I think, I was looking into this, and then they said, look, we almost had no other choice because these are the folks that made our business. We have to show loyalty to them. And it's a business that's always had a little bit more of like a grassroots, organic, edgier vibe. This is not I was thinking, if you think of like Facebook and Google as being sort of mainstream blue chip, the prom king and the varsity quarterback, Reddit's always been a little more like the chess club, the kind of the drama people. It's kind of got that edgier, outsider vibe, and I think that's why they wanted to do this, to be a little bit different.
And you mentioned that they has that Web 1.0 feel, and they have that going for them. Is there any talk among the user base concerned that they're going to become a Web 3.0 company? They're going to be talking AI, that kind of thing. I would expect some of those concerns, but how realistic?
Like they're going to go mainstream, like we saw the band when they were a little and cool, and now they're playing at the big stadium. I don't like them anymore, that kind of thing.
Yeah, Bob Dylan, historical example.
Yeah, I was there when they were small. They mentioned a lot of AI in the S1. I'm not exactly sure how AI applies to the Reddit business. I think obviously these days it's du jour. You have to kind of mention AI and what you're doing with it. I think it can help probably with curation. And one of the things that's always been a little spicier with Reddit is the content can be not quite as advertiser friendly.
It's not all family.
Definitely not. Yeah. And that's it's supposed to be a haven for free speech. So the AI, I think, could be very useful to moderate some of the content that could be potentially in violation of their norms.
Cameron, how much is riding on Reddit's IPO just in terms of then the future tech IPOs or the activity that we could see play out between now and year
end? Sure. We had a little wave at the end of 23. We thought that was going to kind of open the floodgates. It hasn't. Yeah. We had Kava, and then we had Klaviyo, Instacart, Arm. Most of which have done pretty well. Actually, Instacart's had a recent run up. Arm, I think, has doubled. And then it was quiet until now. So Reddit will be kind of the first, I think, major 2024 IPO in the tech space. And if it does well, I think you will see the other S1s that have been kind of mothballed get dusted off and hopefully brought out. Maybe Databricks, maybe Arctic Wolf, Intercom, Klarna. Some of these names have been thrown out in the tech space.
Yeah, I just love that the revolution may be Reddited. We're going to see that IPO. We're going to see those comments in real time coming. I'll give you the floor here. Anything else we haven't covered that you think might be unusual or interesting about this IPO?
It's been a 20-year journey for them. The cap table's got a lot of different folks on it than you typically see. There are celebrities, Advanced Publications, which I think is the Condé Nast company, owns a huge chunk of the business. Because over the years, this is a company that's had a lot of kind of transitions, CEO changes, and it's been a long road. So it'll be interesting to see what happens with them. And indeed, if a $6.5 billion IPO at that size, is that enough to really kind of awaken the market for these other names?
All right. Well, thank you for stopping by here, Headline venture partner Cameron Ansari.
Thank you.
And we're going to take it over to Ines Ferre, who is at the leadership board or at the Yahoo Finance board right now with an update on oil.
Yeah, that's right, Jared. And we are seeing oil rallying again today after that 2% gain that we saw yesterday, and a couple of reasons for this. One is U.S. falling inventories. The EIA data came out this morning showing a fall in inventories for crude, also a fall in inventories for gasoline. That data also, along with the API data, showing also a fall in inventory last week, and that has sent oil higher. And then you also have those drone attacks that have been happening against the Russian refineries, and that is impacting the oil markets as well, because those Russian customers have to go elsewhere in the world to get their products if those refineries are damaged. So we are seeing WTI that's up above $81 a barrel. $80 is that psychological level. We're seeing that above 81. Also, Brent crude above $85 a barrel. So some geopolitical risks here, along with this inventory data, is what has been sending oil higher. I just want to mention Brent up 12% year to date, WTI up 15% year to date. And mind you, also, gasoline has been going higher as well. It's expected to keep going higher in the next couple of weeks. This does not bode well for inflation, as we saw in the latest inflation print earlier this week, guys.
Great point, Ines. Can't underscore enough. WTI above $80 is a big deal and does definitely affect those input prices that we saw earlier. Thank you for that, Ines Ferre. And coming up, Nvidia shares are lower this morning as investors anticipate its big AI conference next week. We're going to dive into that next. Shares of Nvidia pulling back today as investors look ahead to the chip giant's GTC conference next week, where the chip giant is expected to debut new techs. And our next guest just boosted his price target on the stock to $1,000 from $850 in anticipation of the big event. Joining us now is Matt Bryson, Wedbush Securities Senior Vice President of Equity Research for Hardware. Thank you for joining us today. Just big picture, what can we expect from this conference? There's a lot of attention on Blackwell and some of the new technology that they're bringing, but what's the overall vibe?
I mean, I think the overall vibe is going to be positive. They're always very positive during these GTC events. A lot of what they talk about is very big picture, and it tends to be things that you might not see for some time. But at the same time, Blackwell is a big deal. They've said before that they don't think they're going to be able to meet the demand for the product initially because it's so strong. And so I think a lot of investor focus is going to be on exactly what that chip looks like, when it will debut, what it might be priced at.
So Matt, what does this mean then for competitors? We know Nvidia by far the leader within the space, but when you take a look at some of the rivals out there, specifically AMD, how far behind is that going to leave some of the other names within the space?
That's a great question. I think having said that, AMD has gotten, I believe, 4 of the large U.S. customers to buy into their solutions. I think there's interest from the cloud, the cloud data centers in having a second source, and having options. And so I think through 2024, AMD is still going to ramp revenues. You have another event out there, paralleling GTC. It's a startup called Cerberus. They're showing off their wafer scale chip. Again, they have a niche, very high-end training, and I think they'll still do very well in that niche. And so I think there's demand for more than just NVIDIA. Having said that, I think that NVIDIA, in bringing the cadence of its products to market faster, is certainly doing its best to maintain its share lead.
And Matt, I want to talk about another chip manufacturer here that's in the news, and that's Intel. They were slated to get $2.5 billion from the Pentagon, but it looks like that's coming back. Could you just give us some of the intel we have? This is based on a Bloomberg report from, I believe, yesterday.
Yeah, so what Bloomberg is saying is there was a defense allocation. It was going to be $3.5 billion. The $1 billion of that was going to come from CHIPS Act funds. 2.5 was going to come from the Pentagon, and that the Pentagon is stepping away from that funding. I haven't been able to validate that. I think at the end of the day, Intel is going to be the biggest single winner from U.S. funds, or U.S. funding of chip makers. Do they get the full allocation? Do they not? I'm not sure. From a doesn't matter perspective, Intel said in the past that if they don't get what they think is the right level of funds, they may have a somewhat smaller scale out in the U.S. in terms of production facilities. But I don't think it really changes the story, where with Intel, it's do they get their foundry process right? And if they get that process right, I think they're right back in contention as being one of the main suppliers of server and PC chips.
Matt, if we do see a little bit more momentum from some of NVIDIA's rivals out there, what is that then going to do you think, in the long term for the growth story there? Because when you take a look at, once again, 80% growth here, the fact that the stock has been basically shooting up to the moon over the last 18 months, what does that then do to those comparison numbers a couple of years out?
That's a great question. Part of it is going to depend on the growth of AI, and it's really difficult to figure out exactly what the TAM of the market is right now. We have a market that's growing at an explosive speed. You've had numbers thrown out there like AMD talking about $400 billion in accelerator TAM in 2027. If the market's growing to $400 billion, and AMD is right, even if NVIDIA is losing share, they're still growing at an accelerated growth rate through that period. And so honestly, I don't think it matters. The other thing to remember with Nvidia is they've done a lot to create a competitive moat. So yes, well, Microsoft is able to potentially use an AMD by doing its own background work on the software to run the models. Not everyone's able to do that. Nvidia in its development of CUDA, in seeding CUDA in universities, in funding startups, I think they're making it really difficult for their competition to take a bunch of share. And so I think it's at some point, Nvidia remains the market share leader, even if they don't have quite the same amount of share they have right now.
Last question here, and I'll somewhat give you the floor. Any surprises that we might see in the chip industry over the next year? Things not necessarily in purview here for a Main Street investor, but that you might see coming down the pike?
Surprises.
Or just something in general that is sticking out to you that maybe we haven't touched on here.
Yeah, no, so I think with regards to AI, people have been very focused on the AI opportunity. They haven't thought as much about the ancillary parts of the infrastructure that are needed to support AI. And so in particular, I'd call out the opportunity in memory. Companies have been underinvesting in DRAM and NAND for storage for the last 2 years. We've started to see that dynamic shift, more so due to producers limiting production versus demand picking back up. But you look at AI, demands a ton of high bandwidth memory. So that drives memory demand. That's more resources that the memory vendors can't spend on mainstream DRAM, mainstream NAND. And at the end of the day, AI is all about storage, right? Generative AI, you're generating data, so you've got to store it. And it's based on using a bunch of data to train models. And so I think the memory space is really one of my favorite spaces right now. And I think that the names in that space, Micron, WD, do very well.
Both near or at
AI
record highs.
Yeah.
All right, Matt Bryson, Wedbush Securities Senior Vice President of Equity Research for Hardware. Thanks so much for hopping on with us this morning. We look forward to your reaction to the event next week. All right, keep right here on Yahoo Finance. Much more of your market action ahead. Again, you're looking at a mixed picture here for the three major averages. The Nasdaq just above the flat line. You've got the Dow off 16. We'll be right back.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
cost of dining out continues to outpace your weekly grocery bill. Meals at restaurants and bars cost diners 4.5% more compared to a year ago, with restaurants honing in on price hikes due to persistent labor inflation. But despite those stubbornly high restaurant prices, our next guest is still bullish on fast casual names like Chipotle and Yum Brands. And for more in the sector, we're joined now by John Tower, City Director and Restaurant Analyst. So thank you for joining us here today. Break down your view for us on some of these faster restaurant names that you're covering.
Yeah, thanks for having me. So we're constructive on Yum, Darden, Chipotle, and a few others in the space. And effectively, there's a few things we like about them. From the fast casual standpoint, we think that those businesses have fairly strong momentum, and what they're doing is carving out a category that sits obviously between full service dining and limited service dining, an attractive price point with higher quality food. And those are still in their infancy in terms of where they are with respect to growth and the opportunity in the US and abroad. So we think that where they're hitting with the consumer right now, especially with this respect to the demographics, they're hitting younger, they're hitting wealthier. That works really well. And given the backdrop in the US at the moment, where it appears as though the lower income consumer is cutting back quite a bit on their consumption away from home, perhaps pivoting to grocery as an alternative. We like brands that have momentum. Yum Brands is a little bit unique in that they're a global quick service operator. We like them because, frankly, they continue to open stores across the globe. They're using franchisee capital to make this happen. And specifically, what we like that's slowly emerging for them is this digital platform that they've built out, effectively creating capabilities for their franchisees that allow them to become more digitized across their system. And Yum is going to be capturing more of that revenue back to themselves instead of farming it out to third parties as they previously did. And we think that's going to allow their franchisees to become more profitable, which will then fuel greater unit growth across the globe over time, across the three major brands that they have. So
John,
those two, Chipotle and Yum, are right up there.
Yeah, John, I'm curious to get your perspective on the pricing strategy for Chipotle and Yum. How do you see that playing out going forward, given the fact that, yes, prices are obviously still higher than they were a year ago in many respects, but we're not seeing anywhere near the type of increases that we were a year ago?
Yeah, I think the argument can be made that so long as employment and jobs continue to grow and wages continue to move in the right direction, particularly in the US, there is room for these restaurants to continue to take some modest pricing, right in line with inflation. And you think about it, they're considering the costs. The primary cost buckets are going to be food costs and labor costs. And both of those, food inflation's come down relative to where it has been in recent years, certainly labor inflation as well. However, they're still moving upward. And so the idea of these concepts going from, say, high single digit, in some cases, high or low double digit pricing down to low single digit pricing makes sense. Now, obviously, there's markets like California where wage rates are going to be shifting quite dramatically starting in April, and brands are going to have to price to offset that in the market. It's TBD in terms of how that plays out for demand. We're a little bit more nervous for brands that have overexposure there and haven't had strong momentum in underlying traffic going into this period of likely higher prices. Could you see traffic drop off pretty dramatically in response to that? Yeah, you could. But those brands that have momentum, which means they've been giving a fairly strong consumer proposition for some time, right? Typically good food on the plate and strong throughput. We think those brands are still going to outshine the rest of the category. That's your Chipotle is a good example.
And John, I just want to focus in on Starbucks for a second. We've been talking about the labor market, labor costs, and Starbucks is no stranger to labor relations. We'll just cap it there. You're writing in one of your recent reports, Starbucks remains the most debated name in your coverage universe, with interest ebbing and flowing around key investor events and bears seemingly controlling the narrative over the last few months. What are some of the events we're talking about here, and how could we see that evolved in the share price?
Yeah, so they've had a number of investor events the past couple of years. More recently, it's been around earnings and investors kind of setting up as playing the game or effectively trading around events. Our expectations above or below what, broadly speaking, investors are anticipating, and effectively the stock has unfortunately moved into a bit of a trading range rather than kind of this persistent growth forward that many people have been used to with this name for a very long time. There's a lot of issues that we think are happening at Starbucks at the moment. First and foremost, stumbling traffic in the US. It's really kicked off since mid-November, and it doesn't appear, based on the data that we can look at, that it's improved that much starting this calendar first quarter of 2024. And, we don't know the exact causes for it, right? There was some problems with labor earlier around the Red Cup Day in November. They appeared to get tied up into some social media confusion. Was that part of it? We don't know. But, when you look at it, this is a brand that is premium price point, but they've got over 16,000 stores in the US. They're bigger than McDonald's, right? So that means their customer base is representative of the US. And that means they're going to have consumers that play at the low end and those consumers that play at the high end. But when low income consumers start cutting back on spend away from home, they're likely going to feel it in their model. And I think that's what you're seeing here. Their most recent earnings call, they spoke about the afternoon seeing the greatest pressure in the US. And I think that's a function of that being the most discretionary occasion within that kind of beverage away from home event. And then, there has been competition. Abroad has been a bigger issue than it has been domestically. Domestically, I'd point to C-stores in likely the form of, alternative energy drinks as potentially being a greater value for the consumer relative to what they can get today at Starbucks. And that's been weighing on their business. So I think, what gets this to work, we outlined it in our note. We think that, there could be some major changes that need to happen, but more realistically, what could happen, I think if the company articulates some of the cost savings and really dives deep into whereabouts in the model these changes are taking place. They've outlined about $3 billion in cost savings over the next several years. They talked about 2/3 of that coming outside of the stores, really hand-holding for investors how this is going to play out over the next several years will at least provide some confidence that the earnings growth that they've targeted of 15 to 20% or so the next few years will come to fruition, even during this period of more kind of tumultuous sales and traffic in the U.S.
All right, John Tower, always great to get your insight. Thanks so much for hopping on and talk to us this morning. Cities Director and Restaurant Analyst. Thanks, John.
Bye.
Well, Eli Lilly announcing a partnership with Amazon. Eli Lilly has signed on Amazon Pharmacy to dispense certain medications like migraine and diabetes drugs, including GLP-1s, directly to consumers as part of its new program, Lilly Direct. Amazon is just one of the third-party outlets Lilly will be using to stand up the program. Earlier this year, the pharma giant announced that it would start selling drugs directly to consumers while still maintaining the current sales and distribution model that involves pharmacy benefit managers and other middlemen to get to the pharmacy counters. Keep it right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Let's take a look at another trending ticker that we are watching, and that is Robinhood. Shares moving to the upside, up just about 7% in today's trading action. Bernstein initiating coverage with an outperform rating, a $30 price target, saying that it continues to benefit from the crypto comeback. And Jared, when you take a look at what Bernstein is saying, comparing that to the numbers that were just released from Robinhood for the month of February, They clearly are benefiting from that crypto comeback.
Yeah, real quickly, assets under management for Hood, custody-wise, $119 billion. That's up almost 60% year over year. Equities trading volume, that's just stocks alone, up 41%. Options contracts trading volume, that is up 33%, and cryptocurrencies up 86%. And a lot of that is just a function of prices. So we're seeing stocks at record highs, we're seeing crypto at record highs. I think there's a huge retail wealth effect that we're seeing with respect to these crypto prices, where people are finally back in the green on their crypto purchases there.
They certainly are. When you take a look at these numbers, extremely impressive. Now, this is the second month in a row for Robinhood of one of their milestones that we should point out here when it comes to the second month in a row with assets over $100 billion. And digging a little bit further into this call, Bernstein expecting crypto revenue to grow ninefold in 2025. That's
Why
just
not
next
10?
year.
Why not
Massive
10?
growth.
All right, we got to talk about AB InBev shares because they are moving to the downside today. This comes after the Marlboro cigarette maker Altria is selling over $2 billion worth of its shares in the beer maker. And this is just a portion of Altria's shares. It owns about 10% of the company. And in fact, AB InBev has said they're going to buy about $200 million worth of these shares. So that's going to be a share buyback. So a bit of confidence by the company there. But this really is a deleveraging story by AB of some of these companies like Altria of their stakes in this maker.
Yeah, separately here, the brewer also agreeing to buy back 3.3 million ordinary shares here from Altria for $200 million, offering the buyback, reducing Altria's stake here ultimately from about 10% to 8.1%. This is all according to the statement here. But again, two top trending tickers here on Yahoo Financial. Looking at AB InBev, those shares off about 5% in today's trading action. You can see over the past 2 years, we're not too far from where we were just 2 years ago. Certainly a lot of volatility within this space. Lots of questions about demand, what exactly that looks like. Obviously, the massive factor of the boycott of Bud Light having a real impact on shares over the last year. But again, this at least moving the stock today, and certainly a name to keep on your radar with the top trending ticker on Yahoo.
Yeah, and I do have some street commentary. Here is RBC. James Edwards Jones sees the announcement as a negative for sentiment and that it's likely to act as a short-term break on AB InBev share price, but it is a minimal longer-term significance, saying the stake sale is not surprising, but it would have welcomed Altria divesting its entire stake to remove concerns about some residual overhang on the stock, Shauna.
All right, again, shares off about 5% in today's trading day. We'll keep it right here on Yahoo Finance. Coming up, Lead This Way is back. We kick off our series premiere of our second season with Vanessa Pham, Omsom's co-founder and CEO. More on how her company is dominating the Asian food space and how she's positioning her company for growth. That's in the next hour. That's all for us today. Rochelle and Akiko have you covered for the 11 a.m. We'll see you tomorrow. Have a great day.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's a look at what I'm watching so far this morning. Retail sales rebounding in February, recovering from a steep decline at the start of the year. We'll uncover the underlying health of the U.S. consumer, though, just ahead.
Shares of EV maker startup Fisker nosediving. The Wall Street Journal reporting preparations for a possible bankruptcy filing. Is this EV maker running out of road?
And season 2 of Yahoo Finance's series Lead This Way kicks off today. We'll take a dive into the ethnic food market with Omsom co-founder and CEO Vanessa Pham. Tune in later this hour for more on what this is going to mean for the Asian startup to get off the ground.
First, though, as always, let's take a look at where major markets are trading right now, or major indices, I should say. 90 minutes into the trading, the Nasdaq, the only one in the green, although trading pretty flat right now. The Dow down 61 points, the S&P 500 down 10. This coming on the back of hotter than expected inflation print. This is wholesale inflation we've been looking at, producer price index coming in hotter than expected. And we are seeing that reflected in the Treasury market as well, as we see yields move higher right now. Let's take a look at where things are. The 10-year yield at 4.28% and the 30-year yield at 4.42. Well, former Treasury Secretary Steve Mnuchin announcing on CNBC this morning that he is putting together an investor group to buy TikTok. This comes after the House advanced a controversial bill Wednesday, giving China's ByteDance 6 months to divest TikTok or face a U.S. ban on U.S. app stores and websites. Mnuchin saying he thinks the legislation should pass the Senate and TikTok should be sold. There's a lot of shoulds in there, Rochelle, when you think about what needs to happen between now and a potential sale. Of course, we're talking about this bill passing the House, has a more uphill climb in the Senate. And then really at the end of the day, the question is whether the Chinese government would allow a sale if it does come to that. We did get some commentary from the Chinese Foreign Ministry, the spokesperson overnight, saying that if the so-called national security reasons can be used to willfully suppress other countries' superior companies, there would be no fairness to speak of. No surprise, the Chinese government responding here to this bill. But that is the big question still about whether if this bill does pass, if the president does sign it, would TikTok still, or would the Chinese government allow ByteDance to sell off or spin off TikTok if it would come for that? If you look at the past, they've said very clearly that's not on the table.
It's true, and I mean, we're really still looking here for clarity on what classifies whether it's the conduct or the potential for conduct when it comes to national security threats, which was some of the pushback that we've seen from the Chinese Foreign Ministry, as well as this idea that because a company is doing well, it's seen as being anti-competitive now to force a divestiture or a sale here. And it was interesting, Mnuchin saying this morning that this should be owned by U.S. businesses. There's no way that the Chinese would ever let a U.S. company own something like this in China. And so you have to then wonder if they're using the same tactics then as they would use in China, where does the difference go then? Where does this go from here in terms of tit for tat and this cloud over what counts as national security or the potential for national security? We have seen this continuing to escalate, things with, connected cars, even with the, smarter ports. As we get more advanced technology, really blurring those lines here for what that means if you're a foreign company trying to do business here that involves US data, Akiko.
Yeah, Rochelle, you raised the question about whether, in fact, what the U.S. is doing, the critics would say, look, how is this any different than what's been happening in China? And in many ways, we have seen China use the same language that the U.S. has, right? When you think about the iPhone ban, I know I keep raising this, but this really does sort of strike me as similar language than what we've heard from the U.S. Government employees not being allowed to use iPhones, saying specifically that because it's an American company, it doesn't mean that data is safe and there could be a potential backdoor. And this is the argument we have heard the U.S. raise with Chinese companies as well. So there is a little bit of tit for tat already happening. The question is, if this does in fact lead to a forced divestiture and China says no, how is this going to escalate the tensions that already exist between the two countries?
Indeed, people continuing to throw their name in the hat, but as we mentioned, still has to get through the Senate and even then some potential legal challenges, which we'll also discuss coming up later this hour. right, well, shifting gears to look at retail sales rebounding in February after seeing their steepest decline in nearly a year during the prior month. For more on the modest rebound in retail sales and what this signals about the consumer in the months ahead is Michelle Meyer, Chief Economist at the Mastercard Economics Institute. Thank you for joining us this morning. So, Michelle, I want to get your takeaways for just how well the consumer is faring, given what we've seen with this rebound in retail sales, modest though as it was.
Well, it was nice to see the trend in February return to what we were seeing before the noise in January. We know that the turn of the year tends to be very volatile, high seasonality, particularly around the holidays. So it was a little bit hard to really understand where the consumer was going at the start of the year just from January data points. And now that we have the full month of February, both from the Census Bureau's retail sales numbers, from our own insights through spending polls, we certainly did see a return to trend-like expansion in February with characteristics that were very similar to what we were seeing at the end of last year for the consumer.
Yeah, Michelle, to your point, data is always backwards looking. But when you think of what we've heard so far from some of these retailers on where the consumer is, what does that tell you about how much upside we can continue to see moving forward, given the state of where the consumer is today?
Yeah, look, I think the consumer is empowered in this environment. The reason I say that is they are facing an environment where for many categories, prices are now falling. Think about what we saw even in today's report with some of these larger durable goods items seeing declines. Part of that is because prices are falling. And that means that consumers have a bit more real purchasing power. When you look at aggregate wages versus overall CPI, you are seeing wage growth outpace inflation of prices of goods and services, which means that, again, you have that real purchasing power. So I think that's supportive. I think that's quite helpful. And I think it's reflective of the fact that we're evolving and where we are in the business cycle, where the labor market has remained quite resilient. But yet we have seen easing across some categories of the consumer price basket. Not all, but many.
So, Michelle, let's dive into that as we look at what we've seen with goods, the growth of goods retail sales versus services here. As we look at some of the things in the Spending Pulse February survey here, what stands out to you as perhaps some surprises or some strengths that you're continuing to see here?
Well, it's pretty amazing, the consistency of the story, which is twofold. One, we are continuing to see outperformance in terms of spending online versus the store. And that is also reflective in a broad data set. So you are seeing consumers continue to embrace that online presence. You're also seeing evidence of experience-based spending still doing well, whether that's restaurant or travel, or even these moments in time where consumers are spending. We recently published a report with the Mastercard Economics Institute looking at how the Taylor Swift concerts impacted spending behavior across the U.S. as an indication of what's to come as she enters the scene abroad. And it's meaningful, where consumers really do show up and spend in a significant way for these moments in time. We looked at the ski season as well with our research to try to identify how consumers were spending on specific travel moments. So consumers have the ability to spend. They are prioritizing, they're being mindful of prices, but they have that power right now.
Michelle Meyer, Mastercard Economics Institute Chief U.S. Economist. Good to talk to you today. Appreciate the time.
Same to you both. Thank you.
Well, time now to take a look at a trending ticker, and we are watching shares of Fisker this morning dropping. Take a look at that. We're talking 16 cents a share now. This comes on news from a Wall Street Journal report saying the company may now be preparing to file for bankruptcy. CEO Henrik Fisker joining us on Yahoo Finance a few weeks ago, sounding a little more optimistic about the road ahead.
I believe that we have a future, otherwise I wouldn't be here. And I believe we're going to manage to get out of this, I would say, general EV slump that there is out there. We still see a huge amount of interest in our vehicle.
Let's bring in our very own Pras Subramanian, who's following this story. Pras, in many ways, Fisker not alone. We've been talking so much about these upstart EV companies that have really been struggling to scale up. What's the very latest on this company and what looks to be a bumpier path ahead?
When we spoke to Henrik Fisker during that interview before, it was around the time that they were
supposedly in talks with Nissan for a cash infusion to keep the company going and also leverage some of their designs to be used by Nissan there. But it seems as though that deal may not be happening right now. As you mentioned, the journal reporting that Fisker has hired bankruptcy advisors for a possible filing. The company has about $1 billion in debt and only pulled in about $250 million in revenue last quarter, so a bit of an imbalance there. So I think the big question to keep goes, what's next for the company? Like you mentioned, this is a tough time for EVs, and a lot of them are struggling, but Fisker obviously hitting some sort of cash crunch here. Does the company file for bankruptcy, recapitalize itself using money from another creditor? That could be an option. Does the IP of Fisker get sold to another company? Maybe it gets bought by Nissan in bankruptcy. Who knows? Remember, Fisker's first company was bought by a Chinese concern, and they recapitalized that, and they used old designs for a car called the Karma automotive car. So that has also been an option. So I think for Henrik Fisker's case, he probably does not want to go through that yet again.
And so, Pras, a lot of people might be wondering, you're just sort of rearranging the deck chairs on the Titanic at this point. Seeing Fisker as a penny stock here, still having those production delays as well. How likely is this going to be a story that ends well here for Fisker?
I think it has to do with, are they able to get more money in the next, couple of days? Are they able to recapitalize without a bankruptcy, get more from a traditional OEM? Because they do have some IP, they do have some designs. They have a car that, though delayed, sold a few thousand last quarter, and they do have a contract manufacturer in Magna in Europe that makes these cars. So they do have some value here. The question is, it's funny, Rochelle, a lot of people say, was this company knocked out by a YouTuber named Marcus Brownlee, who reviewed the car? He's a very popular YouTuber, and he said it was the worst car he ever reviewed. Some say that sort of turned the tide there, if you want to use another Titanic reference, as to why Fisker is in a tremendous amount of difficulty right now, because it sort of probably hit their sales tremendously after that review came out.
Goodness, the power of social media indeed. Appreciate you, as always, our very own Pras Subramanian. All right, we've got all your markets action still ahead. Stay tuned. You're watching Yahoo Finance. The U.S. House of Representatives passed a bill that could lead to a ban of the social media giant TikTok on Wednesday. The legislation moves to the Senate now, where it has a tough road ahead. So what sort of legal precedent does a bill like this set? Well, joining us now on this is Ramya Krishnan, Senior Staff Attorney at Knight First Amendment Institute at Columbia University. Thank you for joining us this morning here. So now, obviously, this is still a big if it does get through the Senate and gets signed as President Biden said that he would. In terms of how the legal scrutiny goes from here, how narrow is this bill? Because that's really been the argument, that it's so narrow that it just applies to TikTok.
Yeah, the whole debate around whether this bill just forces a sale or imposes a ban is really a red herring. Generally speaking, the government can't accomplish indirectly what it is forbidden from doing directly, and that's precisely what this bill does by forcing ByteDance, TikTok's Chinese owner, to sell the app or to have the app banned. So this bill is going to run into some pretty serious First Amendment trouble. And that's because Americans have a First Amendment right to access media and social media of their choosing. To justify the ban, the government would have to show that its privacy and security concerns can't be addressed in narrow ways. It hasn't done that, and we doubt that it could.
Ramya, we have seen divestitures being forced before as a result of Chinese investment, looking specifically at dating app Grindr. We saw that company, the Chinese company who purchased Grindr, having to have to sell it as a result of the CFIUS review. How is this case different than that?
Yeah, well, I mean, one difference is that Grindr was forced into divestiture as part of the CFIUS process, which could apply to any technology company. Part of what's really astounding about this bill is that it functions almost like a bill of attainder. It singles out TikTok, and for really no good reason. The primary justification the government has used in promoting this bill is that it protects Americans' privacy. But while it's true that TikTok collects a lot of our data, other platforms do too, and this bill would do nothing to stem that flow while allowing China and other foreign adversaries to continue purchasing data from data brokers and data aggregators on the open market. So at bottom, the fact that this bill is ineffective is going to be fatal in any First Amendment analysis.
Ramya, I want to get back to that comparison on Grindr, because you said that was subject to a CFIUS review. That's the case with TikTok right now as well. That hasn't necessarily been resolved years later. It's been undergoing a review through CFIUS for a while. If the case for Grindr was about national security risk, which is what was raised through CFIUS, can TikTok, I'm trying to understand what the difference is in the circumstance. Can CFIUS in this case come forward and say the same with TikTok and say there is a national security risk? Does that legal bar need to be set high? If CFIUS just comes in and says, we got a national security risk, this app cannot exist as is.
So I don't think that would necessarily save a ban on TikTok if there were an attempt to impose that ban through the CFIUS process, because the fact remains that that in order to protect America's national security, we don't have to ban one of the most popular communications platforms in the world. And I would just note that, banning citizens' access to foreign media and social media is a practice we usually associate with authoritarian regimes. We should be very wary before giving that kind of power to the US government. We should consider, for example, how that kind of precedent would be weaponized by undemocratic governments around the world, and how it might be abused by a future US administration.
And as you note here, invoking national security isn't a get-out-of-jail-free card for complying with First Amendment rights. But if you're a multinational company and you're wondering what that means for you, the sort of risks that means if you have a business here and you might be forced to divest, or at least challenged by Congress to divest here, what does that mean for multinational companies? How are they getting roped into this?
Yeah, well, I mean, the bill itself, notably, while it singles out TikTok and forces a sale or says you will be banned otherwise. The bill also empowers the president to ban other foreign-controlled apps if he deems them to be a national security risk. And it's notable that the definition of foreign-controlled app is pretty broad. It doesn't just encompass companies that are headquartered or based in foreign adversary countries. It would also include companies in which foreign persons from those countries have a direct or indirect at least 20% stake in subsidiaries of those companies. But more broadly, there's a real concern here, I think, that if the US goes ahead with banning TikTok, that's going to spawn copycat measures around the world, that it will essentially be an invitation to other countries to ban American-owned and other foreign-owned media and social media. And that would be a real disaster, I think, for free expression globally.
Ramya, really quickly, if this bill does pass the Senate, the president signs off on it, what's the legal channel, legal avenue or path that TikTok can take to challenge it?
Well, it can absolutely challenge the ban on First Amendment grounds in court. That's precisely what it did with Montana's TikTok ban. And notably, that challenge resulted in success. A district court in Montana has enjoined that ban, finding that it is very likely to violate the First Amendment. So I think TikTok would have a pretty good case here that this ban is identical to that one in all the ways that matter, and so should fail First Amendment scrutiny.
Certainly be interesting to see how and if it goes through the Senate, where it goes from here. And of course, that timeline will still have about 5 months for TikTok to make up its mind about this as well. I appreciate you breaking all of this down for us. Ramya Krishnan, thank you so much.
Thank you.
All right, we've got all your market action just ahead. Stay tuned. You're watching Yahoo Finance.
Well, Tesla shares falling more than 30% since the start of the year, with a number of factors leading to that decline. The EV giant has received several analyst downgrades, including one from Wells Fargo on Wednesday. There's also concerns about a slowdown in EV demand. Let's talk about where investor sentiment is likely to lead to now. Ross Gerber, Kawasaki Wealth and Investment Management CEO, joining us now. Ross, we always like to talk Tesla with you, but I wonder where you think about where Tesla has fallen right now. Is this just about Tesla coming back down to reality where fair value should be? Or are there fundamental questions about its growth potential now?
Well, unfortunately, I think it's kind of both, in that the original story that I think most investors bought into with Tesla didn't really include Elon and Twitter. And I think for a long time, we all hoped that it really wouldn't affect Tesla and the demand for its products. But we all know that that has now happened, and the demand for Tesla products is obviously lower, and they've had to discount and do many things to hurt margins and returns and ultimately, profits for Tesla. So, you've got that problem, which is where's the bottom when they don't advertise and they don't do anything to create demand, but the CEO of the company every day goes out and hurts demand through his actions, literally every day. Yesterday it was Don Lemon and Mr. Free Speech, but I don't like the guy who interviewed me, so he's fired. That's not free speech. So I think, investors have had enough, and we see the fallacy in this business model now where the king of advertising the brand is now the devil advertising the brand, basically.
So Ross, this is tough, and I know you're someone who, this is a company that you like, that you follow.
I love the company.
Exactly. So how hard is it then to try and value this company that started off as a car company, then is considered more of a software company, and then you bring in some of the personality of the CEO as well coming into the mix? How do you end up valuing accurately Tesla?
Well, the way we've always valued Tesla is a tech company. First of all, in its heyday, it traded 100 times forward earnings in the end of 21 when things were, as good as they could be for Tesla. So part of it is a valuation coming back down to earth. And when you align it with forward multiples from Microsoft, Nvidia, Google, Apple, the Mag 7, let's say, 35 to 40 times forward earnings makes a lot of sense. So if you're looking at $3 for this year, that's how the Wells Fargo guy gets to 125. And so, 40 times earnings seems like a fair multiple for a company that isn't growing earnings, but has an incredible potential future. But, this could turn around very quickly if either like Tesla gets a real CEO who's actually going to help the company, or Elon changes his tune and actually comes back to working at Tesla and promoting the brand in a positive way. So they've got great products. The Cybertruck is amazing, but it's just literally a business lesson of an amazing company being brought down by its CEO.
Yeah, but Ross, you said you value it as a tech company. What's the tech catalyst here? For months we heard from so many Tesla bulls who said, look, this is an AI company, but there's not an AI product out there. When you think about autopilot, it's not at the level 5 that was claimed to be.
No, it's not an AI company, and Elon's made it clear he's not going to build AI at Tesla, which is even more upsetting to me. Especially because Tesla could have owned OpenAI in hindsight, and boy, that's worth now $100 billion. So, there's a lot of stuff going on here, but Tesla's technologies, battery technology and scaling advanced battery technology, 4 megapacks, for example, for utilities, the technology behind the Tesla manufacturing process, as well as the battery production process, not to mention full self-driving, which is still an impressive piece of technology. But what they've done is they've been able to scale EVs like no other company's been able to do in the world. And so we now see for sure the moat that Tesla's built is pretty deep, being able to make 2 million cars and nobody's even close. So I think, it's not a car company, that's for sure. Can you call a Cybertruck like a regular truck? It's not a truck company. So I think it's a tech company, but it still doesn't change the reality that companies trade based off the perception of its future earnings. And now that perception is changed to a much lower perception of future earnings. And that's why there's so much pressure on the stock. And once again, it could be reversed immediately if Tesla took actions to improve the brand and advertise its products.
And Ross, I have to ask you, because as we talk about the Cybertruck here, you know, another one of these halo products gets more eyes than you're seeing, especially these early adopters very keen on it. But was it a misstep then to not focus on cheaper, newer Tesla vehicles versus sort of this price cut up and down that people are seeing as well? What would have been perhaps the better strategy here?
Well, no, I don't have any issues with their strategy. And the car is very reasonably priced now with the discounts and the EV credits. So you can buy a Tesla for in the mid $30,000 range. And if you're smart, you can buy a used Tesla for way cheaper. And there's actually like very little or no depreciation in Tesla's actual car performance. So if you buy a 2 or 3 year old Tesla, it works just as good as a brand new Tesla. So, you know, for investors or car buyers out there, there's an amazing opportunity to buy like a used Tesla at a very, very reasonable price and still get an EV tax credit. So I don't think they need to make a more affordable car right now because they're having trouble selling the cars they have, and they think it's price, but it's really marketing. And so the amount of misinformation about EVs out there is just at an all-time high because they continue to be more and more successful gaining market share against gas cars. And so, you know, the FUD and the misinformation just ramps up the more success Tesla has. So as a company, Tesla's amazingly successful, but for it to move to the next level, they're going to have to change their strategy.
Ross, what do you make of this threat, this flag that those like Elon Musk have raised about competition coming in from Chinese EVs? I mean, can Tesla continue to maintain its market share on a global scale, not just the U.S., but outside of the U.S. as well, with its current lineup, with the Chinese EV makers like BYD continuing to move in so aggressively?
Yeah, I mean, I think this is a reality. I don't think China is going to be that aggressive in the United States for various reasons. But I think in the rest of the world, you know, their pricing and their scale at BYD, for example, is incredible. And in China, because the government has supported EV producers, there's lots of choice and lots of inexpensive choices. So Tesla has to compete head on in China, even though it's a massive EV market, it's super competitive. And, you know, this is a challenge for them. Secondly, being an American company, that, you know, the perception of America has changed in China a little bit too, so that it's not as much of an advantage as it used to be. That said, Europe has had all kinds of issues with people terrorizing the plant there and shutting it down for several weeks, which will cost a ton of money. But I don't think there's any lack of demand for electric vehicles. The price of gas continues to be very high. Consumers can save thousands of dollars a year buying an EV. They're actually better cars, drive faster. There's absolutely no reason to buy a gas car. And that message has to just be, you know, shared to consumers globally, and people will make that choice over the next decade. And I see mass adoption of EVs. Now, how much money is made during this is really what's the question.
Ross Gerber, always good to get your take. Joining us today, Gerber Kawasaki, Wealth and Investment Management CEO. Good to talk to you today.
Yeah, thanks for having me.
Well, coming up next, Lead This Way is back. We're going to kick off the series premiere of our second season with Vanessa Pham, Omsom co-founder and CEO. More on how her company is shaking up the aisles of some of the biggest retailers in the country. That's coming up next. Well, the ethnic food market is on the rise and set to reach $84.7 billion by 2034. As a first-time founder, Vanessa Pham, alongside her sister Kim Pham, they're aiming to push through the noise with their Asian food startup Omsom as major consumer packaged good companies are jumping on the bandwagon. We take a deeper dive into how Pham is doing just that in season 2 of our series Lead This Way, and our very own Brooke DePalma here to give us the story. Brooke.
Good morning, Akiko. First, let's take a step back and take a look at those big players jumping into the market. Spice and food company McCormick, they named tamarind, a sweet and tangy flavor from Africa, India, and the Middle East, the 2024 flavor of the year, while Kraft Heinz told Yahoo Finance new and diverse flavors is one of the fastest growing and most attractive spaces within its portfolio. And a recent report that the company conducted even found that half of Gen Z's favorite foods are ethnic. And after a successful run of 6 limited Heinz sauces to restaurants last year with flavors like harissa aioli and yuzu wasabi, Kraft Heinz is going to put some of those flavors on grocery shelves this year. Meanwhile, last November, Hong Kong-based food company Day Day Cook went public on the New York Stock Exchange, and the CEO told Yahoo Finance its North Star vision is to become the General Mills for Asian food. So what is behind the recent popularity? Well, social media is playing a big role in exposing and educating consumers about international flavors. And post-pandemic, a lot more consumers are still cooking at home, looking for healthier, convenient meals. And other experts told Yahoo Finance there is room for lots of small players as well, as the category continues to gain share, all leading to the perfect setup for co-founder and CEO Vanessa Pham, alongside her sister, to take the leap of faith, quit her job, and fill in the white space that exists for Asian American flavors on the grocery shelf. And we learned so much about their journey to get to this very moment and all the obstacles Vanessa had to leap over to get here in our newest episode of Lead This Way.
When your sister-run noodle company hits grocery shelves nationwide.
When I was a kid and I was always trying to hide my lunch, or I just didn't want people to come over when my mom was making something particularly aromatic. Fast forward to today, where I get a chance to proudly put this in front of the country.
The types of aromatic dishes Vanessa Pham once tried to hide from the world are now on full display in vibrant packaging on the shelves of major retailers. The brand's colorful journey is also on full display across the internet, thanks to Pham's Now Tell the World attitude.
Every time I go into the grocery store, I always got to take the phone out and do the selfie video. It always feels surreal.
Omsom is a sauce and noodle startup partnering with prominent Asian chefs to offer premium, authentic flavors. This isn't your usual microwavable instant noodles you might think of. A huge step Vanessa and her sister Kim say is part of their personal mission to shake up ethnic aisles at grocery stores and bring these dishes to the mainstream. But the recipe to get here, well, it wasn't a simple one. A global pandemic, Silicon Valley Bank's collapse, and the challenges any 24-year-old would face leading a brand new startup all stood in the way of her vision and mission of spreading her values and culture through the love of food. Tell us what Omsom means.
Yes.
I mean, that in itself just symbolizes so much of the mission.
Omsom is actually based on a Vietnamese word, Omsom. And in Vietnamese, it means rowdy, rambunctious, riotous. It's actually a negative term. It's what our parents would use when they were trying to scold us. And Kim and I were really inspired by that energy. What if we kind of turn that on its head and celebrate that aspect of who we are? And Omsom is all about being proud and loud, especially when the stereotype of Asian Americans in America is kind of submissive or docile. Omsom is our true kind of energy and ethos and spirit.
While hiking in Bolivia in 2018 with her more free-spirited sister, the once risk-averse Pham decided to lean into what she felt was her true ethos and leave her steady consulting career behind.
We instantly circled around the mission and the industry. And the mission is to educate on multitudes within Asian America, honor and celebrate Asian cuisines and flavors, and the industry just had to be food, because for us, it was a love language. It was how we first really learned to engage with our culture as Vietnamese Americans and daughters of refugees.
With nothing more than what the two sisters had in the bank, they set out on their mission to create something unique. Embracing their roots was a catalyst to create Omsom, as they saw an opportunity to tap into the ethnic food market, which is set to reach $84.7 billion by 2034. And investors saw the opportunity too, as a number of them, including the co-founder of the luggage company Away, Jen Rubio, founder of the online wedding platform Zola, Shanlin Ma, and former Whole Foods executive turned VC founder Ellie Truesdell of New Fair Partners, helped fund the Pham sisters' vision. For Pham, embracing her personality, well, that was how she learned to lead the brand. Do you see yourself as more of a risk-forward leader now? Do you feel like you're tapping in to that mission?
I would say that the person who I was when we were first building Omsom is very different than the person I am today. I think my Proud and Loud has actually been embracing who I am, which is very sensitive, very empathetic, lots of feelings, and learning to see that that's a huge strength as a leader if I don't make myself wrong for that or suppress that.
You also founded the company at such a young age. I think you were, what, 24?
I was 24,
24,
a baby,
yeah. How did you push through that noise and say, I may be young, but I'm making a difference?
Yeah. I would say the loudest noise was actually my own self-doubt at the time. And so much of this journey has been actually working with my kind of inner narratives and dialogue. And now I think I'm kind of my own hype woman. So
a hype woman with a core team who have helped her create not just food products, but an environment fueled by the brand's identity and Pham's own energetic outlook, something she has embedded in the culture.
Everybody here is incredibly talented, incredibly driven, and I think enlivened by the mission of Omsom. And I absolutely lean on the team. I think, a strong leader must and should trust and empower those that work with them. I learn from the team every single day.
Pham's journey in starting Omsom has definitely been a learning experience. As they sought out the right manufacturing partner, which they found in Chicago, back in Brooklyn, another huge lesson came their way: how to launch a specialty food business in the middle of a global pandemic.
When we started out building Omsom, we were just wide-eyed. We didn't know what could come. And before we even launched, the first big challenge came. Do we launch in the midst of this pandemic at the start of it, or do we pause and wait it out? And what we realized is that folks during this time are going to be at home. They're going to be wanting to feel a sense of connection and home. And we felt like that's what Omsom's all about. And I think we did make the right decision, despite some folks warning us that it could be a difficult time.
Who were those folks? Those investors, those people who backed you? How did you push over that?
One of my philosophies as a leader is, you've got this whole kind of network of folks, whether they're investors or, other folks. And I believe it's so important to, take in their input, their advice, and their experience like a sponge. But at the end of the day, coming together with, your team, centering your values and finding the best path forward for the company is really, that power is yours. We decided this was the time that we wanted to bring this company to the world.
Just 3 years after launching during COVID, Pham faced another major obstacle.
Regulators shut down Silicon Valley Bank. The FDIC has taken control of the bank deposits. So what's the fallout, the ripple effects?
Leaving the startup without access to their capital right before the brand was scheduled to launch their second product line, Saucy Noodles.
Nothing can really prepare you for that type of, uncertainty. I immediately had to figure out what our options were. And at the same time, Kim and I started working together on how we wanted to communicate what was going on to our community. So we wanted to center our values around transparency and around bringing them in.
Pham and her sister were transparent with their community in a way that you might expect from the young founders. on social media.
We did not know what would happen in the coming days. And so we put our heads together that Saturday morning and wrote something from the heart. Running a proud and loud business doesn't always mean being celebratory. So let's talk about how SVB's collapse poses a major existential threat to many small businesses, including Omsom. I think while we were still very scared and nervous, we felt deeply heartened by the people that showed up for us.
Talk about what values you hold closest to you as a leader.
One of the values that I've really centered in my journey as a leader is being heart forward, which is something that I don't think was necessarily historically celebrated in leadership. You know, it was about being, decisive, being kind of just like leading with certainty and confidence, sometimes at the expense of your humanity. And I feel like at the early stages of my journey, I tried that on, and I was always making mistakes when I was in that, headspace of being something that I wasn't. And so the last couple of years, I've started to accept more of who I am in my leadership. If I'm, working on something in my own journey, I'm open to sharing that. And I hope that that kind of invites people to feel confident and accepted in who they are at Omsom too.
When your team thinks of you as a leader, what do you hope is the message that you're getting across?
I really hope that everybody at Omsom feels valued for who they are and what they bring to the table, and that they feel they have room to learn, to sometimes make mistakes. It's about celebrating your truth and exactly what makes you you. I want Omsom to be the type of place where people are learning and expanding, but also feeling great pride in their kind of natural strengths.
Pham and her team are determined to fill a white space. Think Kava and how it's setting out to fill the white space for fast casual Mediterranean food, or what Chipotle has done for fast casual Mexican cuisine. And now Omsom aims to fill the void for premium, authentic Asian flavors in the packaged food market. That market is expected to grow around 50% globally by 2030. And while Omsom doesn't disclose its finances publicly, the suggested retail price for its saucy noodles and its cooking sauces range from nearly $4 to $5. Since launch, the brand has sold 4 million products and expanded its presence to over 2,000 stores without losing sight of its roots. Pham isn't satisfied yet, though. Far from it. She wants, in her own words, proud and loud Asian flavors to be mainstream.
I want to see Omsom become a cultural force, a household name that continues to honor Asian American communities and flavors and culture every single day. I want us to be in homes across the country, but still hold that ethos and that heart that we do today.
An ethos and heart that Pham and her sister inherited from their parents, who, as refugees, weren't able to take the same kinds of risks. Your parents must be so proud of you. What do you think they think about all that you have done?
They tell us all the time, which I really appreciate. They tell us that we are honoring our family history by the work that we do, and because they're refugees and they've, built the life we have today, it is my, biggest life stream to honor them and do right by them.
If there's one moment that really felt like, wow, I made it, we did it, what would that moment be?
It's when we've shown the people who helped to get us here what we've done. And so it's really my grandparents. We were featured in a spread in El Vietnam, and it's written in Vietnamese. So I cannot wait to bring it to them because they can read it and really understand that. And that'll be the moment, I think, when it really hits me, what we've accomplished.
To see more of my interview with Vanessa Pham, head to our Yahoo Finance YouTube channel. There you can watch an extended version of our Lead This Way conversation, where Vanessa talks more about the lessons she learned following the collapse of Silicon Valley Bank and the kind of community her and her sister want to build around the Omsom brand and its consumers.
Okay, thanks so much for that, Brooke. You got me thinking about food now, right in time for lunch. Appreciate you bringing us that. Well, coming up, new estimates are saying that next year's Social Security cost of living adjustments could be lower than this year's. We're going to discuss more and what it means for you after the break.
Retired Americans may be facing a smaller Social Security cost of living adjustment, or COLA, for next year. For more on this, let's get to Yahoo Finance's senior columnist, Kerry Hannon. So, Kerry, why are we seeing this?
Well, absolutely, Rochelle. What happens is each year the Social Security Administration adjusts the Social Security, the beneficiaries' check each month by the inflation rate. So it's in order to help people stay abreast of rising costs, but it's delayed from 1 year pushes into the next year. So this is early in the game. But what they do is and this week we saw the new inflation numbers, and so people started throwing out estimates about, hey, what might it look like for the retirees' paychecks, so to speak, in 2025. And right now, it looks like it might be around 2.4%, according to the Senior Citizens League and some other experts I talked to, in that range. And again, as you know, it was 3.2% this year. This isn't a huge amount of money. I mean, if it was 2.4%, it would add roughly $46 to the monthly paycheck. This year, the 3.2% added around $59. So it's inflation is abating, so this is good news, but it is there. Now, the problem is that seniors say that even today, this year's 3.2% bump up really didn't help them with a lot of the costs that they did have, because as we see with inflation, there are still those little things that pop up that really are higher than other things. And the things that really strain senior budgets are things like housing and healthcare and even cars and car insurance, transportation. So these are things that are still relatively high. And so people are concerned that it may not be enough.
Kerry, how are those cost of living adjustments calculated?
Yeah, thanks for asking that. It is, so I said it's a little bit early. And so what it is, they take the inflation data from July, from August, and from September, and they average that together and they compare it to the previous year. That's how they come up with a number. They'll announce it in mid-October, and that will go into effect January 1st, 2025. So we're early to the game here, but the one thing that's concerning is that the aspect that they look at in the index, the inflation index, doesn't weigh healthcare as much as seniors say it is costing them. So it assumes, the index they use assumes a 7% of retirees' incomes go to healthcare, when in fact, and seniors tell the Senior Citizens League that, over 2/3 of them said that they are spending closer to 30% of their income on healthcare. So there we have a bit of a disconnect. So it has trouble actually keeping up with the inflation seniors are feeling in their pocketbooks.
It makes sense, especially when it comes to healthcare. You would think there would be a bit more weight in that there to make up for that cost. So as you mentioned, though, still early days. Appreciate you, as always, our very own Kerry Hannon.
Thanks, Rochelle.
You're so welcome. All right, well, let's get your final check of the markets as we head into the noon hour. Still seeing some volatility across the board, though. All three red across the board. The Dow currently down about 0.25%. They're down about 84 points. S&P 500, they're also down about 0.25%. And looking at the Nasdaq, also trading in similar territory. That's down about 35 points. Investors still digesting some of that stickier inflation data, but at least some of that rebound we saw with retail sales. Well, that does it for now. I'm Rochelle Akufa alongside Akiko Fujita. Thanks for watching Yahoo Finance.